If you clicked on this video and you're serious about learning how to trade, I remember when I first started trading, I was scattered everywhere. I didn't have the right place to get all the information. I was all over the place watching YouTube videos, taking different courses. Then this breakdown video is for you. It's gonna teach you guys a lot of the basics on how to get started with trading. We're gonna break down the platforms that we use to execute trades and do something called technical analysis in these markets. All the everyday tools that we use as a trader on a day-by-day basis to find trades in the market. This video is gonna help you guys at the basic level understand what you need to do and what you need to study to become a trader. Make sure you guys stick to the end of this 2-hour breakdown. There's a lot of information that we're gonna go over that you're going to need always in your trading journey. It's not everything. This is just some of the basics that you need to understand as a new trader that you're gonna be doing every day. Inside my Inner Circle community, I have a full classroom from basic, intermediate to advanced to trade breakdowns and blueprints. All the strategies and things that I focus on, from mindset, market psychology, and technical analysis to spot setups in the market. This video isn't everything, but inside my Inner Circle, we have valuable information that is the next step outside of everything you're gonna learn in this breakdown. That has helped hundreds of my students gain proper insights to viewing the Forex markets. These are things that are always gonna be in your foundation that you're gonna perform on a day-by-day basis as a new trader. So I'll leave you guys this video. Hope you guys enjoy it. I'll catch you guys on the YouTube streams live weekly. What's good, guys? In this video, we're gonna go through a quick walkthrough on Tradingview and the basic layout and interface of it. Tradingview is the #1 charting platform that I use on a day-by-day basis, and I've always used it since 2016. I've been a Tradingview member. Actually, you can see here, this is my account, a venture. I have a premium account, and I started on Tradingview in March of 2016. So I've been using Tradingview for a long time now. It's been second nature to me now. It's something that's natural, a part of my everyday analysis and charting on gold, cryptocurrency, and Forex pairs. So in this video, I'll show you how to use Tradingview, guys. I'm gonna walk you through the basic layout and how to get started with charting on Tradingview. Now, Tradingview is a free platform. There are other ways you can upgrade and have more features, but when you're getting started, free is enough for now at a basic level, especially if you're a new trader. I mean, if you're an advanced trader, you might find some reasons to want to upgrade in the future as you progress more as a trader. But what we're gonna do right now is just go through the basic layout of Tradingview as you get started. When I started trading and charting on Tradingview back in 2016, like it says over here, it was pretty daunting to me. Tradingview was like, whoa, it was pretty confusing because there were so many things on Tradingview. There's a lot of different features, a lot of different tools on Tradingview. And I remember when I first started as a trader back in 2016, I was like, damn, this is a lot of stuff to take in. I was kind of like scared of looking at all this stuff, like this is all the stuff I gotta learn. If you look at the left here, these are our drawing toolbars. And I remember seeing these as a new trader, like, damn, I gotta learn all of these different things, like every single one. I'm gonna have to use every single one of these and learn all of these different tools and features and use them in my trading. It was kind of like a lot and overwhelming in the beginning, but as I spent a couple months learning about trading, learning about Forex, I realized I didn't need all of these things. All of these things could be used for different criteria, different strategies, or different types of traders in the market. I'm going to show you guys throughout this video the tools that I mainly use on a day-by-day basis. If you follow me on my YouTube streams and you watch my YouTube videos, you'll notice there's not a lot of tools that we actually use. There's maybe just a handful that we focus on. So the left toolbar is going to have all your drawing tools. These are things like trend lines that you can draw downwards and upwards when it comes down to something called trend lines, which is a technical analysis tool and a way of drawing on the charts, kind of like support and resistance. We have our different drawing tools up here, like trend lines and even horizontal lines. Horizontal lines are really useful to plot what we call support and resistance levels. So these tools here are all drawing tools that go on the charts. In all honesty, we don't use every single one of these. So as a new trader, don't go to this looking at it like I need to learn every single one of these, right? Because when I started, that's what I thought. But then I shortly realized, oh, I don't actually use the pitchforks. I don't use disjoint channel. All these channel things at the bottom and where it says pitchforks, I don't use any of those. I don't use any of these. All I really use here is horizontal ray, horizontal line, and the trend line tool. So really, I just use 3 tools that are in this line section. So on the left toolbar, we have different drawing tools. We have the lines, as you can see here. In the lines, I only really use 3 of these tools. Again, number 1 would be trend lines. When we draw down trend lines or up trend lines. We can draw trend lines in an uptrend, and we can draw trend lines in a downtrend. As you can see here, there's a nice upwards trend line climbing up on gold. If you look right now, we had a nice downward trend line here with multiple touches that just broke out. If you look right here, we have another trend line coming up right here where there's multiple touches, kind of showing gold is in an uptrend. If I bring out the horizontal line now, I can plot some levels of support and resistance, like right here or like right here. That's what the horizontal line tool is really good for, is plotting out levels of support and resistance or key prices, areas on the chart that we might notice where price is likely to react. At the top, you have your top toolbar. We're going to get this in a minute because this is really important. This is called your time frames. Notice at the top here, it says 1 minute, 5 minute, 15 minute, 30 minute, 1 hour, 2 hour, 4 hour. This is our top toolbar, guys, which I'm going to talk about again, and that's our time frames. So remember that because we're going to get into that in a minute. Other tools down here include Fibonacci retracement. If we go down the list of the drawing tools, there's a lot here actually. But again, like I said kind of not too long ago, we don't need every single one. All of these are based on different market conditions and market strategies. Honestly, when it comes down to the next section underneath lines is going to be Fibonacci and Gann patterns. Now, honestly, to be transparent with you guys, I've been trading now for over 10 years, since 2015. A little bit over 10 years now is when I got introduced in the market. I made Tradingview account in 2016. I started trading in the summer before that though. So 2015 summer is when I found Forex, currency pairs, Euro USD, USD Japan, USD CAD is which primarily what I focused on when I started trading. If you notice up here in the top left toolbar, there's a search symbol section. Right now it says XAU USD. That's gold, okay? We can go here and search up any market when it comes down to stocks, Forex pairs, and cryptocurrencies and futures like indices. Indices have become very popular for trading in the last couple of years. When I started trading in 2015, 2016, currency pairs were really hot, and currency pairs are still very good to trade if you know what you're doing. Over the last 4 years, I would say indices have become very popular, and so has gold trading. Gold is known as a commodity, and it is known as XAU USD. Silver is another commodity. It is known as XAG USD. That is known as silver. Silver and gold have very big markets as well, contributing into the Forex market. Gold is traded in Forex, and it's also traded in futures. It's also in ETFs and in stocks, different companies that mine gold. So there's different ways that gold's actually traded. It's traded a lot in the futures market. Same with silver. But gold is known as XAU. So when we say XAU, we're referring to gold. We can look at all the currency pairs here. See these different sections that say stocks, funds, futures, Forex. So futures are going to be where your NASDAQ is, your US 30, and all of the different assets and indices inside of there. Forex, all your Forex pairs are right here. You can search them all up one by one like the Euro USD. Now, notice how there's a bunch of Euro USDs. Are they different from each other? Maybe slightly in some prices and times of the day, how the candles are showed on the chart. These are different brokers, different exchanges that offer the price feeds for these currency pairs. FXCM, Oanda, Forex.com. So for a quick minute, I'm going to click on the chart and remove these drawings, show you guys some basic stuff here. So notice how I have a bunch of stuff drawn on the chart right now. I have some scribbles. Fibonacci retracement tool right here is what I'm drawing. Notice how it's black because we can't see it right now. So I got to change the colors actually to this. What we can do for anything we draw on the chart is change the colors. I'm going to show you real quick how I can change the colors of my Fibonacci retracement tool. I got to double click it. I got to click on where I drew it. Every tool I have on the chart, or everything I have drawn on the chart right now, I can change the colors for. So the trend lines, for example. Maybe I don't like the colors for the trend lines, and I want to change those colors. I double click the trend lines, and the settings icon and box is going to appear for it. Notice how it says trend lines there. Text, coordinates, style. Style is where we're going to change the color. I can make it red, something that will stand out on the black background. Okay? The support and resistance lines, I can change the colors and the settings for those. I can go to style. I can change how the lines even look. This could be just color preference, maybe a personal preference type of thing, how you like to draw and keep your charts maybe neat and clean to your own personal preference standard, right? Some people don't care. Some people don't. Some people like maybe thicker lines on the chart. Some people might like smaller, thinner, maybe a bit more cleaner lines, dotted lines you can see here. So it's all kind of like a preference thing to your own standards, and over time you might change your charts up. One day you might be drawing with this color, the next day you might be switching the colors up. It doesn't necessarily matter. I'm going to show you guys, it doesn't necessarily matter, but I'm going to show you guys some chart layouts real quick as we go forward. So this is kind of what the basic of Tradingview looks like, right? So we're going to actually change our background real quick. All right, we're going to go to settings. And what we're going to do is change the canvas up. So notice there's different settings. There's tool settings. So I can draw a horizontal line on the chart. And I can click on that. I can click right on the horizontal line. I'm just double clicking with my mouse or my keypad. Double click with your mouse or your keypad on your laptop. And you have the settings for that. The horizontal lines is key for coordinates. We can coordinate it to a specific price. Maybe I want to put it at 3,400, exactly at 3,400 on the dot. Or maybe I want to put this coordinated at 32.25, exactly on the dot. Or right now, where price is at, maybe I want to coordinate this at 3,300. Now, this is important when we talk about something called key price levels and whole numbers. We can put our horizontal lines at support and resistance levels that we see and mark key areas on the chart and key price levels on the chart. But we can change the settings for anything we draw on the chart. So remember that if I draw a downtrend line, whatever color it is, I can choose that to my preference. Right? I could draw another downtrend line right over here. I could draw another one here. I could draw another one here. And I could draw some uptrend lines. Let's say I want to remove all the stuff I draw on the chart. It's messy now. I can quickly do that by going remove drawing tools. But maybe I want to put that stuff back. Boom. Boom. Real quick, you can do that, and it's fast because you might be trading, you might be drawing some stuff on the chart, and you may want to put it back. For instance, let's say I draw some levels here, and I draw some levels here, but it's all in the way, and I want to make the chart a little bit cleaner and get a new view. I can just quickly remove, and it's like, okay, I got a new view of the chart, but I can go back here to undo and put that stuff back real quick. All right. You can also save your charts and load new ones. That's what comes with some of the extra features in Tradingview. But what we're going to do real quickly is go back to some of these tools and talk about them. You have patterns here. You guys who follow me on the YouTube streams will see I don't use any of these patterns. These are all based on something called harmonic patterns. So you have different types of harmonic patterns and something called Elliott waves. Elliott waves is a good topic to learn about. I would study Elliott waves. That goes into a lot about market structure. But these tools we don't use necessarily them all. I never really have used them. These are where you can draw different harmonic patterns. Me personally, I don't use those. Never have. Never have I used harmonics. Never really found them as something important in my trading or that added on to my trading to be profitable and make profits in the market. So this section, personally, never used, don't find it reliable for me. It doesn't mean it isn't a topic and section you can go into and study in the market. It's kind of like over here, this section, the only thing I use is the Fib retracement. That's a good tool where we can draw Fibonacci retracement levels, and it's a whole nother topic that we can deep and dive into. These tools, again, don't use those as well. There's a lot of other tools like the long and short position. This is where we could project like where we're entering and where we're going to be putting our stop loss and our target. And we can gauge in something and calculate something called risk to reward ahead of time using this tool. For instance, if I wanted to sell gold right now, or if I wanted to look for buys on gold, if it were to come down, let's say gold were to come down to here, to this previous resistance, and I was looking for a buy here. I wanted gold to come down, and let's say I was gonna buy here. See how I'm using some of these lines to draw some of my arrows on the chart? I can use the long position tool to project a risk to reward, calculate a potential risk to reward. Let's say I was gonna be targeting the highs and putting my stop loss at the lows behind me. There's a low here, and I see this as a good potential entry area. I can start to calculate some things ahead of time with this. So that is the long and short position tool. We're gonna have a lot longer videos on all of these things inside of my inner circle. So for those of you guys who are inside my inner circle, you get trainings and teachings on all of these tools in longer versions. This is just a quick little skim onto the Tradingview basics for you guys that are new. There's a lot more other drawing tools here, like the arrows, where we can literally draw arrows on the chart. Notice how I just drew it as black. That's because I got to change it to white or a different color that fits the background. I can change my background. I'm going to show you guys a few different colors that you can switch your Tradingview charting background, because a lot of people ask me like what mine is and how I get mine the way I do. So I'll just show you real quick. It's really simple. You first want to make sure there's no grid lines. So we're going to take none. We're going to do no grid lines. So the background is just solid background. You want to do a black background right there. All right. Really simple. Now notice how the ticker is on, right? What's the ticker? That shows you, again, it can show you the time frame, and you can even have description there. So notice on the back there, it says XAU 1 hour, gold spot. I like to take that off. That's the ticker and interval and description. If we go to the right here, we have our different pairs here. So what do I like to do? I like to make different sections here. So let me delete all these and show you what I like to do. And the first one I like to put is XAU. And then I like to put XAG. And then you can even put something called GC, gold futures, gold spot. Now, this might not be available on the free version. That's where kind of some upgrades and features come in. But honestly, that is not needed if you're just a basic trader. It's just another way to look at the gold spot price, because there's a difference between the gold spot price and the gold forex price. And the charting might be it's right on it's right on same chart. They move the same, just different pricing a bit. At times that can be significant. Now we can go here. I like to kind of just keep gold at the top, and then I like to do Bitcoin USD, and then I like to do Ethereum. More of the major cryptos I just like to keep here. I have another list for other cryptos, but more just like majors or the ones that I have my biggest holdings in, because any of you guys watching this video that are familiar know I'm into crypto as well. So I'm into gold, crypto, and forex. So I like to add a few cryptos here. Notice I start with XAU, put some Bitcoin, XRP. I'll just put a few that you guys are probably familiar with watching this video, just like this. I'll leave it at that. And then I like to add some currency pairs like Euro USD, AUD USD. We can search up any currency pair, right? GBP USD, and kind of go down like that from the majors. USD Japan. You could add NZD USD there if you like that pair too. USD CAD. And that's how I kind of like to section things out with my pairs and keep my pairs. Now, it's pretty cool. You can make different lists, so you can add different sections or different lists. So you could go here and you could go to create new list. You could create a whole new column and you could name it anything. You could say Forex pairs. Save that, and it's going to be a whole new column for that. Notice here, how I have recently used here where it says Forex pairs, and I have different lists. I have cryptos, so I have a bunch of cryptos here. I have Forex pairs. So deleted symbols is just the ones that you delete from your recently used or when you delete a section. So notice here, like I have cryptos, I have Forex pairs. We just made Forex pairs. So you could add your USD. Let's say you want to add your USDs in one section. So something like this, GBP USD, NZD USD, USD Japan, USD CAD, USD CHF. Maybe just the majors is something more that you focus on for your trading. And then DXY. We can add the US dollar currency index there as well. So we could just scroll through these at different times of the day. Now we're going to finish up with the charting background. But one thing you could do is even add a section. So you can have section 1 and section 2. Section 2 could be maybe your Japanese yen currency pairs. There's different ways you can section out how you analyze things. I'm going to show you in a minute as we go forward. So let's just add a few Japanese yen pairs. CAD Japanese yen. What else? GBP Japan. We don't need to do all of them. There's CHF, JPY. I don't look at that pair at all. You guys know I like to look at gold mainly. But you can add different sections here if you want to section out like your Forex pairs and be a little bit more organized and neat with things. It's good to be like that, right? Section 1. So you can see up here. You could even do it. This is section 1. This is section 2 technically. If you want to add another section, right? It could be section 3. And that could be like your cryptos. Maybe you add your cryptos there. Bitcoin USD, ETH, USD. Or even your indices in a different section, right? Sol, USD. So the majors, whatever you mainly look at, or if you're like holding crypto, there might be something that you're holding more of and you like to keep an eye on it consistently. So we could just add a few. I'm going to do it quick. Boom. There's some crypto pairs in section 3. So add a section. Maybe you like to look at indices. Another way you could do this, let's switch this up a little bit for you guys that like currency pairs, right? So let's do a new section, or let's do a new list. Let's create a new list real quick. We're going to clear all this and just create a new list. We could call it the Euro list. You could say the Euro list. And what's the Euro list? It's going to be Euro USD, Euro AUD, Euro NZD, right? Euro CAD, Euro JPY, Euro CHF. You could create a list just based on the Euro pairs. Same thing, AUD, or it doesn't even have to be that. We could rename this and just call it Forex pairs and break it down like this now. Let's go to sections, and we got section 1 could be Euro, right? We know section 1 is Euro. We could add a section, right? Section number 2, that could be, let's say, AUD. We're going to add AUD pairs. So we're going to go AUD USD. We're going to go AUD CAD. We're going to go AUD JPY. We're going to go AUD NZD. We're going to go AUD CHF. Oops, I'm in cryptos, that's why. And whoops. There we go. AUD USD, AUD CAD, AUD JPY, right? We could section it out like this in terms of the major or the last symbol, the minor, right? The major could be first in all of them, or it could be JPY, like it could be USD, 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 right? CAD, 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 CAD. You could focus on all the CAD pairs as the minor in one section, right? But if what we mainly do and what most traders do, right, is going to be kind of how like I'm doing it right now. Like, okay, we have our Euro, we have our AUD. We could do next our GBP pairs, right? We could do GBP here. And that's a good way to section things out. And now you could go GBP USD, you could go GBP AUD, you could go GBP JPY, you could go GBP NZD, you could go GBP CAD, right? We missed Euro GBP up here for the Euro section. So Euro section missed Euro GBP. Might have missed a few pairs as I was doing this, so you can drag it to there, right? So just like that, we got GBP USD, GBP AUD, GBP Japan, GBP NZD, GBP CAD, GBP CHF we're missing there. Not that I look at that pair, but it's like what this does now. It's like, okay, I can look at all the GBPs. And it's okay, let me see where the GBP's at in terms of major. Because I know obviously GBP USD to the dollar is like the most like major GBP pair, but GBP is a big currency that moves a lot in the London session. So it could be good to maybe like see like what's the GBP looking like? How do the GBP pairs look like? Do they all look bullish? Do they all look more bearish? Are they all showing some signs of strength? That could be a good mix or opposite type of correlation. It could be good to look at all the AUD pairs. All the AUD pairs look like one's dropping, another's dropping, looks like one other's dropping, looks like this could be setting up to drop, and looks like this might set up to drop. Some are stronger, some are weaker. There might be a familiarity or a pattern that you notice with all of them in a similar essence. Next, you could do XAUSD. You could do another section and maybe have like your mix of things even. You could add a section and say, okay, I'm going to call this my mix, or, my metals, my commodities, other. It could be any name. Let's just say mix for now. And that could be a mix of things. What's that? XAUSD, right? Maybe XAGUSD, right? Maybe BTC USD, right? Ethereum. We'll just stick with some of the majors and largest things. US 30, right? Dow Jones. And the NAS. We'll put the NAS 100 in there. We have a mix of things down there, more of your assets, your commodities, and such. So far we've gone through a basic rundown of a lot of things on TradingView. The next thing I want to go over is indicators. So you have your list of indicators here. You can see I've favorited some that I've studied with, but these are where you can find your technical indicators on TradingView. All right. This is stuff like the stochastic, which is a very, very common indicator, which goes at the bottom of the chart. Some indicators will go at the bottom grid of the chart. Some indicators will go on the top grid of the chart. For instance, I can look up the moving average indicator here. And we can put that on the chart. So we have the moving average indicator now on the chart. This indicators toolbar is where you're going to find all your different technical indicators in the market. And again, if I click settings, I can remove indicators. This button up here undoes everything, puts it back. Removes, puts it back. So if you draw anything, even indicators, you put them on the chart, you can remove them, and you can even put them back. Next to that button is something called replay mode. This is where those upgrades and other features that TradingView has come into play for studying. Replay mode, you can go back on any section of the chart and kind of simulate price action from that point and study from there. It's really good for something called back testing in the market. So another cool thing you can do on TradingView is publish an idea. I'm going to show you guys real quickly how we can publish an idea. And this is something I used to do a lot when I first started trading. I'm going to actually show you because I've been a member since 2016 here, but notice I have ideas published on my account. This is how I used to practice way back in the day when I first started trading. I would publish ideas. You can see the first idea I have published here was May of 2016. So TradingView has a pretty cool feature that I used to use a lot to see my ideas. Look, this is so far back that I can't even go back that far to see the idea, but basically it shows you pretty much a before and after of what you drew on the chart. See, that kind of shows it for the moment there. And that's where we are right now. So I was kind of wrong there. Yeah. Let's see if this one loads. See, because these ideas are too far back, they would typically load and show you the price action moving forward. Because some of these ideas are way too far back, it doesn't show that. But you can kind of see this idea, because this is the most recent one that I drew, was for Ethereum. You can see when I click load new bars, it sets the bar forward, kind of replays them. It's kind of like replay mode here on TradingView, the cool feature that it has. So the last thing I want to show you that I get a question a lot on is my charting background. So settings, what you can do is either make it white or black. I'd like to take the ticker off and the interval and the description off so it doesn't say anything on the background. It's just a flush background. So you can choose between the white, but you want it solid background, no grid lines, and then you can see the other things that I have here we're gonna maybe want to increase this text color a bit to black here and change this, because the text for the price, if you have a white background, you're gonna want your text black and your lines black. But if you change it to black background, you're gonna want to now go white and then white on white with the black, and then put this up. That could be flush on the black. You could see it's the grid line around the chart. It goes around the chart. So if you have a white background, you're not going to see the price. You're going to want to change the text to black, or any color of your preference. Honestly, it can be any color of your preference, but the black stands out on the white there, as you can see. So that's the grid. The grid I don't do too dark, like I don't do it too thick of the color. I keep it just kind of like neutral, a little bit shaded in there. Not too bold of a color. Now, the only other thing is the candles. So what you got to do is just change the candles, the borders of the candles. So this is where we could choose between a few colors. We could go black borders. So you want your borders black, and that's what gives the candlestick the sharpness. Now, wicks also black. I like to make the wicks black if it's the white background. So you can see it adds some sharpness to the candlesticks right there. It's a clean background, adds some sharpness to the candles. We could save this. So now we can go to settings, and we can go to template here, and we can save this as light theme. So now light theme is saved right here. Now we can go back to the settings, and we can go to canvas, and we can go to black. And now we're going to change the text to white. We're going to change the lines to white. We're going to turn the white lines up a little bit here on the black background, just a little bit, kind of in the middle, maybe 50% is good. All right. Now we still have to change the candles. We can directly click on the candles to change them. This time we're going to want to change the wicks as white as you want between like these three shades over here. The last three shades. As white as you want. Like the last two are good, or even the last one. Even though the third one's not that bad, right? We could change the borders too. If we want the borders to stand out a bit more, we can go a lighter black. We can start to go our way down, kind of like we did before. More of a lighter black like this. If you want more of an edge, more of a sharpness to your candlesticks, right there. Or we can go a different green on green. If we take green and we go a different green on the green, so we could have different green on green, and this will help create that more of that sharpness you can see. So it's more of like a color preference thing. You can go the red on different red, and that sort of creates that different sharpness to the candlesticks. Now I can make the wick even a little bit brighter if I wanted to, right? Green on different greens is what's going to sort of create that more sharpness, like on a different green. See? A red on red versus the other one was green on black, red on black. So kind of mixing between those, your eyes might seem one. Like I like this. This is what I like personally right here. So I can go to template, save as on the template, and now we're going to change this one to dark theme. All right. Last one is going to be the red and blue. This is another one a lot of traders like. So we're going to change the canvas back to white. Okay. And we're going to go back to symbol. We're going to change our borders to black, and we're going to go, we could go blue on red or blue on white, as a lot of traders, blue on more a neutral color a lot of traders are using. And now we got to change the wicks back to black. So this is another background that a lot of traders like. The only thing we're missing is the price. So notice when I change it back to white, I can't see the price right now. So I got to go back to canvas, change this to black. Boom. So those are your color templates as well with your TradingView basics, because that's a question we get a lot when it comes down to it. if I want to publish an idea on TradingView, it's really cool and simple. This is a way you guys, especially for you new traders watching this breakdown course video, I used to practice this a lot. So if I ever saw like an idea here, notice I took a tool called the rectangle. So this is a rectangle tool. We talked about the drawing tools at the beginning. That's another tool that we can draw along with other ones like circles to mark out our lows, to mark out our highs here in the market. All right, publish an idea. This is going to help you maybe practice a bit because you can see your before and afters. So let's just say I have a gold bullish bias. I'm just going to keep this real simple. I'm not going to write much for this, but just simple gold bullish bias. I can make my own notes, like looking for a pullback to these retracement levels, whatever it may be, for a pullback to reach these levels. I can make it private or I can make it public. So there's a way to do that. I think when we publish it and get closer to that. So right here, there's could be privacy settings where you can make it private so only you can see it, and you can make it public to show the world. I'm going to make this private real quick, and you can make this an analysis in the tutorial. The bias is long, and this is optional stuff that I can choose right here. Don't need to do that. This is just my analysis. So notice this, look at this. Now this is on my TradingView account, but it's private. Only I can see this, so I can use this for even journaling setups. Because if I look at this in a week from now or a month from now, it's going to show me what the candlesticks did afterwards. So when I go back to my profile now, notice here, I can see the idea that I published privately for myself. If I published it public, it would still be there, same as it is right now. And this is cool now because it has a comment section where I can add notes and update the idea as it goes forward, taking different screenshots and saving it as it goes by. So now you guys know some of the basics of charting and TradingView. In our next video, we're going to go over how to read candlesticks and talk more about indicators and a topic that we call technical analysis. This is going to help you guys understand how to chart more and use some of these tools that I talked more about in this video. So I'm going to show you guys now how to draw trend lines and things like support and resistance, zones and areas on the chart. These are some of the things I like to draw on a daily basis on my TradingView chart when I'm doing technical analysis on gold and Forex pairs. So we can use trend lines to give us a sense of market direction, to help us spot market direction and breakouts and help us find trade setups and entries in the market. A trend line is like a directional tool. It's like a support and resistance that we draw more on an angle, and typically we would want to see 3 touches, but 2 touches can start to create a trend line. We're going to have bullish trend lines and bearish trend lines. So downwards trend lines and upwards trend lines that flow with the market's trend. The market doesn't always go up in just a straight line. It goes in zigzags and in waves, as we call it. So what we're going to do is something called top-down analysis. We're going to go right here and click on the time frames toolbar, and we're going to start this example on a monthly chart. We can start to draw our trend lines on higher time frames first, and then scale and work our way down to smaller time frames. So when you're drawing your trend lines, a key pro tip is to start on the monthly chart real quick. And we can find what could be known as the monthly time frame trend line. So at one point, there was a trend line starting to form here, but you can see the structure has really traded away from that. We could have presumably thought at one point the market could pull back to this trend line. That's how a trend line works. It works like a support, but just on an angle of the market's trend. 2 touches can start to create that trend line from a low. Most traders will look for 3 touches to confirm a trend line in the market direction. So if you look right now, we're on a monthly time frame on Bitcoin at the moment. We're going to do another example on some Forex pairs and gold. If we look at the monthly right now, we can start to draw some trend lines from the bottom here and work our way up. So right now on Bitcoin, we can take this trend line out because it doesn't matter anymore. Maybe in the past we could have used it for something when the market went up, but you can see it never came back to that trend line. So that one's far gone. Maybe in the future, if the market keeps angling upwards, it finds its way back to that trend line in the future. If Bitcoin keeps trading up like this and it comes back to this trend line, we could keep going up in the future. And long term, it could still come back to that trend line presumably. That's how most traders will use trend lines when they're drawing different ones on different time frames. It's sometimes how I do things. I'm showing you guys a basic level of drawing trend lines here. There's ways that I like to draw trend lines and different ways I like to think of them. We're just going to keep breaking it down here real quick with the Bitcoin chart. So now we're on the weekly. We could touch up that trend line that we even drew on the monthly here. We can start to see it forming on the weekly chart here. So we have one uptrend line. We could take this one out for now, but remember it's there. That could be a long-term trend line that the market comes back to at some point if it even keeps going up higher. But what we got from here was pretty much two trend lines so far. I'm on the weekly time frame right now, and I can see one more trend line here on the weekly chart at the moment where I can see these two touches that form. And you can see how the market came very, very closely back. We got a touch from here, here, and very closely there. So traders will use the trend line as a tool to kind of spot market direction and angles in the trend. For example, if we go to a daily right now, we're going to see different trend lines on a daily now. I'm going to keep these ones orange, and if we go to a daily and follow this whole entire trend, we can find other trend lines that exist more on a daily time frame. Like right here, for example. We can see a trend line starts to form there, and the market even works its way up more, and more, eventually breaking that trend line. Now, if we wanted to go in more, let's color coordinate this and make this a different color. Let's make it red, for example. If we wanted to go in more, we could see another trend line here that works its way up. Two touches make a trend line that's going to eventually pretty much connect that third. So if we look here and zoom out, we have that yellow one that we drew on the weekly, but we could see some daily trend lines that for the time being, when the market was there, maybe could have been useful for our technical analysis. Here to here, we start to make a trend line, but then we get that breakout. The market even goes up more. There's more than one trend line that we could draw here, right? It goes up here. You have multiple touches right here. 1, 2, and a few. Now, this is the basis of trend lines. This is the basis of trend line drawing, is being able to spot those touches on that angle. You may be able to see multiple trend lines on this chart. For example, there's one way down here on the daily that we may have not seen. Right here. 1, 2, and then another touch. And then you have what's called the trend line breakout. So trend lines can get broken out. They're like support levels. The more times you touch it, the weaker it becomes. Remember that for future reference, guys, okay? And in other videos, you're going to hear me talk about that. If you come into my live sessions and if you're in my inner circle, these are things that we talk about a lot inside of the YouTube streams and inside of my inner circle. Now, there's going to be a lot of trend lines on this chart for different times of the market. We can find daily uptrends like right here where there's an upward trend line connecting 1, 2, and then you have a couple touches there. Some continuation, right? If we're looking at this as a trend line right now, we can see where the market makes this low, and we can connect the next low to it, and we can see the third low gets connected and there's a push up, and then eventually this trend line breaks. We have a breakout of this trend line, okay? We could find another trend line right here. There's a lot of different trend lines on this chart that we could actually find with Bitcoin, right? Even right now, as we look at the live chart in front of us, as I'm recording this video, we could start to draw a trend line right here, as you can see. So this is the basis of drawing trend lines. One of the next things we're gonna go into is called counter trend lines. All right, guys, so what we gotta understand about the trend lines is that we're gonna have down trend lines and we're gonna have up trend lines. Trend lines that go in the downward direction, where price is going, flowing with price. So we can see here a couple of downwards trend lines that the market made. And we're gonna have upward trend lines. Now, one thing that we can use trend lines for is breakouts. The market can be going in an uptrend and there can be retracements in that uptrend. So for example, we could see Bitcoin has been in a massive uptrend, right? We can draw out our uptrend lines like we did moments ago, and we can see a lot of different uptrend lines inside of here that we were drawing before. Now, there is a lot of downtrend lines, and these are pretty much looked at as like counter trend lines, the ones that are going downwards when the market is in an uptrend, like we see Bitcoin's been in. If we look at here, for example, you can see a trend line that I drew here that has multiple touches on the tops, and then eventually that breaks out, goes higher. So if we look at this concept with the trend lines, when the market is coming down on an angle but still in an uptrend, right? Bitcoin's been in an uptrend, but we can find downward trend lines that go with the retracements. So these are retracements that are happening, but they're going in the direction of the trend. So these are good to understand breakouts. Counter trend lines are really good to understand where you could have a breakout coming in the market. For instance, we can make trend lines like this that touch from one point to another that go with the flow of price. For instance, this is an uptrend line that's going with the direction of price. If I go to a smaller time frame, like an hourly time frame, I could probably find a couple downward trend lines in here that go against the direction price is going in. Those can be good for breakouts. The biggest one is here. I'm going to do this example now on gold for you guys. So what we're going to do is we're going to go over to the gold chart and show you a few examples of what I'm talking about over here. So I'm just going to look up XAU USD. XAU is gold, as we've mentioned, and we're going to draw some trend lines here on gold, and especially some counter trend lines. So here's some examples of counter trend lines for you guys. It's when the market is going in an upwards direction or downwards direction, a trending direction, and you start to get these retracements. These retracements can often start to form a trend line over time, which gives you multiple touches, kind of like a resistance, which eventually can lead you to the understanding of a breakout happening at this trend line eventually. You can see gold's been pretty much flowing in the uptrend here, going up, down, up, and then pulling back before going up. You can see there's some buildup of some trend lines like right here. If we go to a 15-minute, 30-minute chart, higher time frame, we can start to see a bigger trend line coming down here. There's a much, much bigger trend line that goes all the way down here. As the market is coming down, you start to form and create this trend line more and more and more as price goes down. So a counter trend line could be looked at something like this right here, where the market is just kind of free falling, but you're overall in a bullish trend. Your market structure is overall in a bullish trend. So if you go back and look at gold, for instance, it has a lot of these types of trend lines. One here at the start of this uptrend that it's been in. These retracements, you can see, all go with the flow of price. So when we're looking at the market in a trending phase, right? Because the market doesn't just move in a straight line. It goes up, but again, it moves in waves, as we've said. So we could see times where the market makes a low, and that goes up into a high. And then we get a pullback. We have that breakout. That trend line can help us in technical analysis. It can be a good tool to help guide us to anticipate that breakout potentially, or where we are in the trend. You can see this goes up for a long time. So if we look at all the pullbacks, they all give us sort of a trend line breakout or more of an angle of price before it starts to go in the upward direction. Even here, the market makes a couple touches and then it just breaks out. You could see all of these retracements that happen on gold. As it pushes up, it retraces, pushes up, retraces. This is the type of condition where we can use trend lines. If the market's pushing up and coming down, it could start to possibly form a trend line, right? If market has gone from point 0 to point 1, we know point 2 is coming, but point 2 can lead to a breakout, especially if we have a trend line, counter trend line. So we have a market in an uptrend, it's starting to retrace, form that counter trend line. We can anticipate a breakout of that counter trend line. That's typically one of the tools I like to use when I see the market trending, and I've always drawn it. So remember, I've been trading for over 10 years now, so the amount of time I've drawn these trend lines and seen these types of trend lines on the chart over and over and over and over and over again. You get a lot of repetition from just spending time on the chart, seeing them with your eyes naturally. You can see two trend lines here. One starts to form. We can have an outer trend line or more of an inner trend line is what I like to call it. So we kind of have the outer trend line and the inner trend line. You can see both of these trend lines break out. So a lot of traders like to use these types of trend lines for breakout confirmations, whether the market's going up or down. So we have an upward trend line here, and you can see how that trend line breaks out, kind of like a breakout and retest of the trend line. So a very common topic that I want to bring up is called the breakout and retest, and you see that a lot with the trend lines. This is a good example of what I'm talking about, and I could teach hours and hours and hours of just this one concept because it's something you can see a lot on the chart, especially if you're a trader who really likes to use technical analysis. If that's what you really lean towards, you're very technical in your viewing of the chart and what you see. Most of the time, that's how I'm using the trend lines, is to anticipate that a breakout can come of them, especially if the trend line has touched more than 4 times. If I really see the market touching that trend line enough times, I get a little weary and think, this is probably going to break out likely of that trend line, because it starts to build up something called liquidity. And we talk a lot about liquidity and concepts like that on the live sessions and in my inner circle. So the trend line shows us where a breakout could potentially happen because there's basically something called liquidity there, which means money in the short sense and the basic sense of it. So trend lines are really good for not only kind of pinpointing like support and resistance and market direction, but even for breakouts in a trending direction or at the end of a trend when it's done trending. You see here, you have multiple touches on this trend line on this angle. You get a breakout, retest of the trend line, continuation. So this is a very, very, very common concept that if you sort of train your eyes to see, you will see it a lot. The breakout and retest of the trend line. If you train your eyes to see it enough times, you will see it on the chart. And that's how you're going to start spotting setups and anticipating certain market moves differently ahead of time before they even happen. So you can see one last example right here where literally, again, a downward trend line. Market breaks out of that and starts to continue that momentum. All right, traders, welcome back to another educational video on one of the most important topics in the market, and that's market structure. This topic is going to help you understand how to read trends when it comes to uptrends and downtrends in any market, forex markets, crypto markets, indices market. You're going to want to be able to read the market structure. So market structure refers to trend analysis and identification of the trend when it comes to highs and lows in the trend. Trends can form on any time frame. It could be a 5-minute chart during the London session that has a market structure to it. It could be a 4-hour chart that has a longer market structure on it, like a month of a trend that's identified. Market structure in forex trading refers to the way price movements form trends over time, showing how prices are changing in relation to highs and lows. Understanding market structure is super important because it helps us traders identify the current trend, whether it's upward, downward, or sideways. So this knowledge allows us to make more informed decisions on when to enter and even exit the market. So knowing market structure is just a really essential component, no matter what type of trader you really are. Like, this is gonna be one of those things like support and resistance that you're always gonna need to study every day, because it's basically the movement of price. And when you understand this down to a really, really high level, you understand there's structures within structures. So when we talk about market structure, we have uptrend and we have downtrend. And we're gonna go more into this topic. This is gonna be the first video. There's gonna be a handful of videos on this topic. This is gonna be probably something we talk about on every session or every single week throughout the week as well on the live sessions. You'll see those in the recordings as well. So what is an uptrend? Well, you have to learn about an uptrend in market structure is you have things called highs and you have things called lows in the market. A high is like a peak, a low is a lower point. So when it comes down to an uptrend, this is how the market structure looks and how it forms over time in an uptrend. Over time, this is how a structure looks over time. Whether that time is a couple of hours, a day or a couple of days or a week or weeks or a month. This is how a structure is formed over time. And depending on the chart and time frame we're viewing, right, we can get different structures forming that are smaller and some that are bigger. So when it comes down to it, you have to understand the market doesn't just move in a straight line. It moves in steps, kind of gradually, with highs and higher highs and higher highs. HH means higher high. HL means higher low. So it just means the high is gradually getting higher than the previous ones and the lows are gradually increasing in comparison to the previous one behind it. It tells us that a trend is maintained. So this is what an uptrend looks like. For an example, this is gold on the 4-hour time frame. So each candle is 4 hours of time. So we're not just looking at 1 or 2 days here. We're actually looking at almost a whole entire month of an uptrend. So you can see I've marked points where the market makes highs and then higher highs in relation to the previous high behind it. But we also have the lows that are increasing into higher lows, higher lows, higher lows, until we form that last higher high in the peak. So you can see this is a market structure that looks similar to this. Trending structures form over time. So this is a structure forming over time. There's different ways we could identify setups on this chart. We're gonna do that in our live sessions. If you've ever been on live sessions, I've talked about it, like break and retest. You might see that on this chart real clearly. Here's a downtrend. For an example, opposite of what we just talked about, guys, when it comes to the uptrend. This is a downtrend, and the market's gonna be making lows, lower lows in your market structure. This consists of lower highs and lower lows now. This helps us know where the market is in terms of buyers and sellers overall through a period of time. When the market makes a lower low, it's likely buyers are about to step into the market. Similar to when a market makes a higher high, it's likely sellers are about to step into the market. Here's what a downtrend looks like on gold, 4-hour time frame as well. So we're looking at a 4-hour chart and the market's gone down, but it's not going down in a straight line. It's starting from a high point, it's going lower, and it's making lower highs and lower lows in the structure. Overall, over about a month, price went in a downtrending direction. So it's like the skeleton to the chart. It's gonna help guide you and know where you are, create a real good framework for your technical analysis. Market structure is something you need to understand when it comes to downtrends and uptrends. But first off, you have to understand 2 types of movements in the market: impulsive movements and corrective movements. So to identify market structure, start by examining key support and resistance levels according to something called the Dow theory. This is one thing you should study that's on the topic of market structure, something called Dow theory. An uptrend forms when price makes higher highs and higher lows. Conversely, so opposite, a downtrend occurs when price makes lower lows and lower highs. So remember, trends can be categorized in 2 types of movements. You have impulsive movements and corrective movements. So within structure, you're gonna have impulsive, corrective movements. An impulsive movement is basically the move that goes in the direction of the trend, but it has very strong momentum, typically doing something called a break of structure. As strong momentum going up in the trend or down in the trend, creating the higher high or creating the lower low. Corrective movements, these move against the primary trend and typically have weaker momentum compared to the impulsive movement. They may not last as long, or as long as they last, there's not as strong movement. You might not get as many pips in terms of movement. So remember that we have 2 types of movements. A simple way to look at it is when we look at the chart here, for instance, we're on gold, right? And we can see a downtrend over a period of time here. The market has been going down for a period of time. We can actually measure it with a tool here called date and price range. We can measure this and see, okay, price was going down for literally 32 days in a downtrending direction. Now, it wasn't just in a straight line. You can see there's points where the market has a high, and then there's points where the market reaches a low, right? So this is a downtrending structure. If you want to see it more clearly, you can flip on a line chart. And a line chart might help you visually see it, maybe a little bit more clearly, where the points bend and where the points peak. So where the market creates these peaks and these throughs, right? Where it goes through a low is here, or even here, you can see an even clearer point where the lows are going lower. If you look at this chart, this market structure keeps going lower, 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 and lower. So it's making lower lows along the whole way down. So this is an example of a downtrend here. You can see the highs are also gradually staying lower throughout the entire way. So these are key components that you need to understand about market structure. You have impulsive and corrective movements. Knowing where you are in price can help you anticipate where the next movement is. Because if you understand the key components of market structure, you understand higher highs can indicate potential sells. Lower lows can indicate potential buys in the market. These are the key components of market structure that you guys have to study. We have another phase in the market that's called consolidation and range. When it comes down to the market phases, we have uptrend, we have downtrend, but we also have something that's more sideways, which is known as consolidation and range. We're gonna get more into that when it comes onto the topic of market structure. So market structure helps us know where we are on the chart. If the market, for instance, is in an uptrend and it's made an impulsive movement and it's corrected, and now we've made a higher high, so HH. This is typically a spot now where the market is going to retrace or find a resistance. We can use things like resistance or candlestick rejections and other price action concepts to anticipate a potential reversal back in the counter trend direction. So that would be trading against the trend. People who are looking to trade with the trend could be going for something like a break and retest, where you're letting the market correct. You know it's likely to come down to go into that next corrective move up. But typically when the market makes a higher high, that's when you're going to fall. Or if the market's in a downtrend, right, and it's making these impulsive movements through a low, this is now typically a point where the market's gonna go into a retracement or go into a buy, and it could potentially continue its trend after it's done that retracement. Key things like support and resistance and even Fibonacci retracement tool are key to identify potential retracement zones in the market. So here's a little cheat sheet showing you structure and price. There's different types of traders. I'm the type of trader who can trade kind of on both sides of the market. I just have to kind of be confident and identify where I am in structure. A lot of times I'm taking sells when the market's making a higher high on gold, or I'm taking buys when it makes a lower low. If I'm getting a continuation with the trend, I'm usually looking for a break and retest that continues with that trend on any time frame. These are the three market phases that you need to understand and that are characterized in the market. Sideways and range, we haven't talked about that too much yet, but we're about to. That's typically when the market slows down in its trend. An uptrend doesn't go up forever, a downtrend doesn't go down forever. There's usually a phase where the market sort of dies down and pauses and loses that strong buying activity or loses that strong selling activity. This is known as your consolidation range, or like your rectangular range. This can be typically seen at the top of an uptrend or at the bottom of a downtrend. It's usually when the market starts breaking out and shifting in another direction. It's really important to understand this in market structure, because as we go through more videos in this lesson, we're going to talk about market structure shifts, trend shifts, something called break of structure, which is something you have to really understand if you're going to identify trends, because trends don't last forever, they can reverse. Typically the top of a trend where it reverses is an overbought stage. Typically the bottom where it reverses is an oversold stage. So there's different market phases that we're gonna study and talk a lot more about in this training and other trainings that include the uptrend, the downtrend, and the sideways phase. These are the three things you wanna study and adapt to in the market, because you could have a currency pair that's trending in an uptrend for 2 months and the market can change and start to go into a downtrend. So for 2 months, you might be used to trading in an uptrend, but then the market shifts and it changes. So there's a famous quote in trading that I always used to hear, that you have to adapt to the market conditions. The market can have trends for long periods of time. It could trend in one direction for 30 days, but the trend can shift. So you might be used to trading a bullish strategy or an uptrend strategy in an uptrend for a period of time, but you have to get used to seeing phases where the uptrends can shift or the downtrends can shift, because you don't want to be caught buying too high and you don't want to be caught selling too low when the market's getting ready to shift. So there's different market phases along with this video and others that we're going to be talking about. But here's some practical steps, guys, for analyzing the market structure. And then I'm going to go over to the charts and show you guys some things. Determine the current trend. So are you in an uptrend or in a downtrend? How are we able to determine the trend? Looking for structures like this. Is the market making a higher high? Have we broken up and made a new high? That tells me now I'm either waiting for a retracement or I could possibly look for a sells. Typically, we're waiting for a retracement to continue in the trend. We can use other technical analysis combined with that. So with that being said, there's other things that you can do to identify market structure that a lot of traders, even myself, do. Draw trend lines. Trend lines can help you see the market structure a little clearer, and also use the line chart. Identify key levels and look for breaks in structure. This is something called a BOS. Use multiple time frames. Get used to seeing structure on multiple time frames. And like I said, the line chart is going to be a very, very, very helpful tool. Before we go to part 2 of understanding market structure, we're going to go to the charts for a little bit and talk a bit more about the charts here and how things can trend for periods of time. This might be a thing that a lot of new traders don't understand about the markets. So what we're going to do is we're going to take a step back a little bit and go to 2023. What I've marked here is January. So if we notice, February is over here. So what did the market do for that entire month, for example? I'm going to mark it green because we can see the entire month was in an uptrend all the way until February 1st. So that's 1 month right there. That is 1 month of price going up in one direction. You have periods of weeks of price going up. You have times where there's weeks prices going up in the upwards trending direction here, right? But overall, for 30 days, the market goes up in a trending direction. The goal in trading is to identify the trend and then try to go with the trend, go with the flow. You want to try to identify the flow, identify a trend, and then go with that trend. That doesn't take being in the beginning of a trend, because the market can trend for a period of time. If you look at February until March, you can actually see February until March was in a downtrend, whereas January to February was in an uptrend. If we go March to April, April's up here. We can see March begins down here. It doesn't just go up right away, but then there's a point where it starts going up. March was in an uptrend. So you have months where the market can be upwards, downwards, upwards in a direction. And you might be able to notice a trend. For instance, January. Let's take a look at January, for instance. What do you see here? Do you see any market structure, right? Do you see any market structure after what we went over so far about higher highs and higher lows, right? An uptrend is when the market is making HH, HL, higher high, higher low, right? So when you look at this piece of the chart, what is it doing throughout time? Throughout time, it's showing some uptrending structure until this point all the way up here, or until this as a reference point, which is a break of structure here. Like I said, one tool that traders like to use is a trend line to see structure is still intact. That's something that can help you draw and kind of guide you through structure, right? We're gonna have videos on trend lines. We're not gonna go over trend lines so much in this video. I just wanna keep it basic at one topic for every video, guys. Because when you're on the live sessions, guys, those go 2 hours, those go 3 hours. They're live sessions multiple times a day. That's where I go in this stuff in depth, as well as the advanced videos. So these are the topics. These are the topics you guys wanna study. But if you look at gold here, the market goes up for 30 days, we could say. Inside of there, can you spot 1 or 2 setups in that trend? That's your goal as a trader. Your goal is to try to spot setups that go with the flow, is what I like to say. Going with the flow is more like going with the trend, because they say the trend is your friend in the market. So can you spot maybe 1 or 2 setups inside of there if you look at break and retest or simple support and resistance? Now I'm going to show you guys the line chart. Some of you guys might see this better on the line chart. My eyes can see it already, but if I go to the line chart, this might help you out a bit more. Like I've talked about, the line chart's a useful tool, right? If you look at like here, you can see a clear resistance point on the line chart that the market breaks above, right? And then we pull back to it. Go to the candles, you could see candles pretty much line up with that area almost to that top point. Even here, we break above and we go up. There's a resistance formed here and the market peaks through it. It goes above it. So you're getting a higher high here. And now your market is flipping a previous resistance into a support level and trading off of that. You might see some of these zones I marked better on the line chart, like right here, for instance. I could see a peak here that the market broke above. It maintains to stay above that. That's how support and resistance works. When you look at here, we break above. This is confirming a higher structure in price. Market runs up. So these are things you're gonna wanna be able to read along the way in your trading. You're gonna wanna be able to read like, okay, this is maintaining a trending structure. Price pushes up, this is a retracement, and then we continue in the uptrend. And then we pull back and we continue in the uptrend. So there's 2 types of traders here. There's the people catching the sells. For instance, higher highs lead to sells. If you notice, every time there's a higher high, that leads to sells in the market. Every time the market goes higher than the previous high, you're getting a sell. All of those have retracements in them that take you higher, right? If you go back over here and you look at this high, when the market goes above it, what does it do? It goes into a sell. That sell is slower than the momentum of the impulse, of the direction of the trend. The sells, if you look at a lot of the sells, some of them are like this, slower, but the upward movement is faster. So this is one key component when it comes to market structure, right? Another thing that we're going to be talking about in our part 2 video is break of structure, market structure shift. That video is about to come up, but I want to show you guys one more thing. When you look at the chart, one thing you can do is what I did. This is a good way to back test it. Go to like a year and go, okay, 2023, there's 1 month. Okay, I can go to the next month. Kind of like I did in the beginning of this training when we got on the charts here. I would go month by month. And you're gonna notice when you start to do this, you're gonna see some months that have more of a trend, and then you're gonna see some months that have less of a trend. You might see some months that have a clear uptrend where it's like, wow, that was a super obvious trend that month. It's a good way to practice because you're gonna have months like this month where you can see a clear downtrend inside of that month. And then even the next month going forward, there's continuation of a downtrend. So there's gonna be months when you look at the market like that, you take a step back, you zoom out, what happens every 30 days, right? Price uptrend for 30 days. Price downtrend for 30 days. Price uptrend for 30 days. This next month, consolidation. And then we go into a downtrend. And then we go into another downtrend. And then the next month goes into what? A uptrend. End of July, beginning of July, end of June, uptrend. And then July, end of July going into August, you're getting a downtrend here. So through time, you have these trends that can last and they can sustain. So 4-hour time frame is a great time frame. Let's go right here, random part of the chart right here. 4-hour time frame is a great time frame to identify that market structure. There's a key indicator on Tradingview. I'll show you guys this. Pivot points, high, low. That indicator can help you out, especially if you're a new trader. You put that on your chart and it marks some of the key like high, swing, and low points. Not all of them, it misses some, but it can kind of help guide you for some of the reference points, like key reference points where a low is. Market makes a high, higher high, higher high, higher high. So if you look at this market structure right here, how long is this? This is from November to December, right there. November 12th to December 4th. You can clearly see in that time, the market was in an uptrend. Do you see one setup that might have clicked here? I see one right here. Why would that have made sense? For a break and retest. For example, you have a high here, and you have the market coming back to that, retesting it. Why would this have made sense? Because if you look behind us, the market's already giving us impulsive moves up. It's already giving structure, and then this breaks through a high. It breaks through a significant high point, creating a new higher high. So this is a retracement that pulls back into a previous structure point and then continues higher. Do you see another setup here? Right here, break and retest. Another one right here. So these are the types of things that we can look for to flow with the middle of the trend. We may not catch the whole trend, or we might not catch the very beginning every time, but as some of the trend goes by, we can look for setups like this inside the trend. So make sure you guys study market structure. That's gonna be one of our key topics inside the academy. You'll see it on a lot of videos. I'll see you guys on part 2. All right, guys, right now we're looking at the Euro USD chart, and we're gonna go over more of the Tradingview basics and getting familiar with how to chart on Tradingview and getting better at technical analysis with all the different tools and features on here. We're looking at Euro USD on the 4-hour time frame right now, meaning every candlestick represents 4 hours of time from when the candlestick opens to when it closes, and then when the next one starts. So right now, one thing I want to pay attention to is the bottom of the chart. If we look at the bottom of the chart, we can see there is dates and times. So we can actually see right there where it says May. So what I'm going to do is put a vertical line right where May starts. So from now until that red line, so from right here where I marked the red line until now, represents all the price movement we have seen in May for Euro USD. If I put a red line over here, we can see where June is. So far, this is what the month looks like for Euro USD on the 4-hour time frame. So if I go on the monthly, May is just going to show as one candlestick, the current month. If we look behind us, we have a blue month. We can see that April was really bullish. It went in the upward direction. The month before, March, was also very bullish. If I go to the weekly though, and I put that same line at May, we can see we can start to break down the chart. Let's go back to the 4-hour, and we're going to put a line at May, right here. That's the start of May. So I'm on the 4-hour. If I go to a weekly, it's just going to be a couple candles so far. What the weekly shows, we could see the weekly was bearish, 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 bearish until last week. And this week currently that we're on. So this current candlestick, you can look to the right here, and you can see it has 3 days remaining. 3 days are remaining on this candlestick because I have the weekly time frame selected. So if I go to a daily, it's going to say a new candle pretty much, because I'm recording this right when the market opened. It says 23 hours and 24 minutes left on the day. So the day just started. Right now, as we're looking at the current candle in front of us, the day is just opening, just starting not that long ago. So there's not much movement on the day, but we can see yesterday was bullish. We can see the day before was also bullish, and we could see some bearish price action in here and some consolidation. It ended up turning right up. 2 bullish days in a row. If I go to a 4-hour, right, today just started, not much movement. But this gives you an idea of how the candlesticks work. Each candlestick, again, represents the selected time that we choose. If right now I'm on a 4-hour time frame, I can see right now on the 4-hour, there's 3 hours and 23 minutes left on this candle. If I go to a 5-minute though, I can see the ticker to the right here says there's 3 minutes left on this candlestick. So when we zoom in on price right now, we're on a 5-minute time frame. So the chart and Tradingview chart here is printing candlesticks every 5 minutes for me because I have the 5-minute time frame selected. There's 2 minutes and 49 seconds left on this candlestick until it finishes and the next one starts to begin. And I can view the different candlesticks on different time frames with that same concept. The 15-minute, I can see on the 15-minute, there's 7 minutes and 30 seconds left on that candlestick until the next one opens and begins its 15-minute direction. If I go to the hourly, there's 22 minutes left on the hourly candle until the next one opens and starts that 1 hour direction. It's going to be very important to know how to interval through the different time frames and the understanding of them. Weekly, daily, monthly, those are higher time frames, whereas something like the 4 hour, 1 hour is kind of more medium neutral time frames, and then you have your smaller time frames, which are the minutes. Those are where we can see price on a minute by minute basis, a 5 minute basis, a 15 minute basis. The candlesticks will print on that number of basis in time, depending on which candlestick we have selected. So it's important to understand this as you're doing your analysis and when you're marking up zones on the charts. Most traders like to start on the higher time frames when they're marking up their charts and starting to do technical analysis and see what they can find on the charts. It's called top-down analysis. Top-down analysis is when you start on a monthly chart and then you work your way down to the weekly, daily, 4 hour, 2 hour, 1 hour. It's something similar that we did in the trend lines, right? So a lot of traders would like to do this when it comes down to making key levels or just analyzing the chart in general for market structure or trends. This is a good way to start when you're on your chart for whatever pair that you have selected. And it's good to form a bias by doing technical analysis using different tools like trend lines and support and resistance. We could draw a trend line here that has 2 touches and we can kind of see the market is in an uptrend. We had a long downtrend that got broken here. Now we're on a monthly time frame. So the only traders who trade off the monthly chart are like investors or position traders. People are going to hold trades for months. They might only have a couple trades a year or throughout the year. Not day traders, scalpers, or even like swing traders at that most. It's more of what we call a position trader. You're not going to spend that much time drawing up on the monthly chart or analyzing the monthly chart. It's usually a quick check. It doesn't take too long to analyze the monthly time frame because the price action moves slow on it. It's good to see how the end of the month is closing or how the beginning of the month is opening up. That's really about it, or understanding that at the end of the month the market can usually form its high of the month or its low of the month. So different things that we could go a little bit more advanced, but when you break it down to a weekly, you'll probably start to find a bit more, right? When you go to a monthly and you're drawing your levels, your trend lines, your support and resistance levels, you're not going to see a lot. And then when you go to the weekly, you're probably going to find like 1 or 2 more things on top of what you already found on the monthly chart. You might find an additional trend line, some more zones, and a little bit more clear price action towards the trend as well. Same thing when you go to a daily. Like when you go to a daily, it's probably where you're going to see a lot more things to draw on the chart, like levels of support or levels of resistance. Right now, as I break down the chart on this, I can see there's a big resistance zone here. So I've taken the rectangle tool. The rectangle tool is really good to draw areas and zones on the chart. So I like using the rectangle tool whenever I see like an area of support and resistance, and I just like to kind of mark it up, or even if it's just a point, one reference point where I'm drawing like right here, this area where I see a double top. And now I like to take the rectangle tool and just kind of make a zone, an area around it. It's something I've always done when I see areas of support or resistance on the chart. So there's like a resistance level here. You can see where there's nice touches there. Market breaks above that resistance, so it goes above the resistance. So it pretty much breaks through the ceiling, and then it comes back and tests it like testing a floor. This would be what we call a break in resistance. And when we talk about support and resistance, that's one of the topics that we go into when we describe and go over support and resistance. It comes down to break and retest. That goes into the category of support and resistance as well, and trending markets as well. You can see Euro USD here kind of created like a mini trend right here, or even here. As you can see, there's a sort of an uptrend line going upwards as this is going up. There's a resistance to the left. This breaks above resistance, pulls back to resistance, works off the resistance. This is some common price action to see. Another thing that we could add in here that we talked about was whole numbers. And we can see right here on Euro USD, $1.11. Right, and I just free roamed the chart here. I didn't even look at this chart. I just pulled up Euro USD for the first time, and what do you know? There's a good setup right there. Look at that. Trend line, trending direction, market structure. Remember, the market doesn't move in a straight line. It can move in waves. So when you're in an uptrend, it's good to get pullbacks. You don't want to be buying price when it's already going blue or already going green, the market can trend, and it doesn't just go in a straight line, right? It will have its pullbacks, its corrections, its retracements. So it's those moments that when we're in a trend, we can watch and anticipate. You can see Euro USD trending nice here. It has an uptrend market structure. It's making higher highs and higher lows. Notice the area after it makes this higher high push up, it makes a high and it starts to retrace back. Notice the area that it retraces back to. We can see a good area of resistance here. And the market also, when we look at something that we call, again, whole numbers, round numbers, or as I like to say, even psychological numbers. A lot of people have a different name for them when it comes down to the whole numbers, right? Institutional levels, key price levels, whole numbers. It's kind of all the same thing, different names for the same mix of things. Institutional levels, key price levels, these whole numbers are really, really important to the market. The market is very sensitive to react at them like a support or resistance, just like we see at $1.11 here on Euro USD. That would be a whole number because after the decimal point, after that $1.11, we just have zeros rounding to that number. So this is kind of tying some things in together that I've taught all the way throughout this course video as well. When it comes down to trend lines, support and resistance, and even areas on the chart. These are some of the simple things you want to practice as a new trader. It might not seem like too much, but as you practice stuff like this, you evolve more and you get more experience on how to draw technical analysis and do things on a day-to-day basis in the market. Now we're going to go on to support and resistance, guys, which is like the bread and butter of Forex trading, any trading in the market. Before I take any trade or start to analyze the market and look for any setup, I'm always analyzing and looking for support and resistance when I plan on looking for any gold trade or any Forex trade. So support and resistance, these price levels are key levels that the market respects, okay? A support is a level that the market tends to bounce off of, pretty much like a floor. The market could be coming to a support, and it can be an area. It can be an area on the chart. It could be a price level. It can be defined by a few things, a candlestick. It could be something to the left side of the chart on a higher time frame where the market is going to bounce. A support is an area where demand comes into the market, where buyers come into the market. It tends to bounce up, and the market can come back to these levels where the market bounce and creates multiple touches. That's how most traders view a support level, is as an area where you can see multiple touches in the market. Now, when you become more advanced, you should understand where the market should form support, not where it has formed support, because there's different ways to view support essentially, right? We can look at an area that has, yes, touched 3 times. That is your typical concept of support, right? And resistance would be the opposite, right? Resistance would be an area that the price rejects down. Doesn't bounce up, it rejects down instead. So it could be a key level. It could be a zone, a point of interest, we like to call it, that the market rejects down. That's what resistance is. Now, resistance can be identified for most traders with 2 touches, right? We can identify support and resistance before it happens, if that makes sense, because we can understand concepts about the market that should help us understand where a support can be created before it actually gives those, let's say, 2 clear touches of an area. All right. Now, when we're looking at the candlesticks, right, no matter what time frame you're on, you're going to see support and resistance. Right now, I'm on a 30-minute chart on gold, and you can see here the market rejects this area, and then when it comes back to that area, it rejects off it one more time. You can see here we have 2 touches. Again, the market's coming down, and I'm on a 30-minute chart, so all these candles represent 30 minutes. The market's coming down for a couple of hours here, and we push up, and then we come right back into that support level, that area where there was buyers. So a support's created, right? We can see buyers come in here. We can see the market's trading down, and buyers come in. The candlesticks are really important. So what we're going to tie in together with this part is support and resistance and a little bit of candlestick. So we can see the market traded down here and it sort of paused. Look at the difference of the candles. You have a big engulfing candle here. You have another bearish candlestick with a wick on the top. But then you get these three candlesticks that sort of pause and then suddenly shoots right back up to the top here. And then when we come back, look at how the market tests this area, how it reacts here. You can see this big wick that forms on this candlestick. After that wick, the market forms a series of bullish candlesticks going in the upward direction. There was support created right here. We can see a support got created when the market came back to this low. So you could have a strong point on the chart. You could have a strong point that the market has moved away from, right? You could have a strong point on the chart that say the market has moved away from. When it comes back to that point, it could be likely and a higher probability that the market can react off of that point. Again, there doesn't have to already be two touches. We can anticipate areas like this that price has pushed away from, come back to potentially act like a support level. So think of them like floors and ceilings, right? When the market comes back, there's a floor created here, comes back, bounces off of that level. There's lots of different, if we zoom out, we can see below us, there's a low here. When we stretch this one zone out, so right now I'm using these rectangle tools that I can stretch to the left and right of the chart to create these areas. What I like to do is create areas around places that I see rejection at. So like here, there's rejection in the market. So I like to create areas around points that I see rejection. I also like to use the horizontal line to mark areas that I see rejection at, like here and even here. I can see in this area right up here at the top that there is a resistance area. What do I mean by an area? I can see between here and here, these candlesticks, the bodies and the wicks have formed rejection in between this whole entire area right here. So right between this area where these two horizontal lines are placed, I can see this area where more than one candlestick has rejected, right? I can see rejection here, rejection here, rejection here, here, here. So my eyes sort of see a bigger area of price. It would be like looking at right here. If I put the horizontal line at this low, my eyes can see a whole area that pretty much forms at this low and then comes across and then here. If we drag that area to the right, if we keep dragging it to the left and to the right, it may stretch out and work as a support in the near future. Even if we just put a line there, for instance, at this low, and let's say this low, and we create that area, we could see more than one touch happens in this area to the left. One here, one here, one here, one here, and even in here. Now as we go more to the right, look how this area reacts. Here, breaks out, resistance, and then even a couple more times it creates a support. If we were to go even to the left over here, we can see the same area creates some action, I like to call it. So action, I like to call this when I can go to a zone and see a lot of action around it. It's a pretty important area for us to keep kind of on our charts and aware of. So there's lots of different ways to look at support and resistance. Like if we're looking at a higher time frame. So what most traders do, and the key thing to do, is to zoom out to a higher time frame. You can start on a monthly chart, but you might not get too much from a monthly chart. You could go to a weekly as well, and it might be sort of the same thing, not too much support and resistance on a weekly. The key thing to identify key levels of support and resistance is, one, zoom out to a higher time frame like a daily or a 4-hour time frame. Look for areas where price has reversed multiple times. So for instance, up here, we can see multiple reversals. Down here, we can see a reversal. We're pretty much just looking for areas where we can see reversals or rejection multiple times. It's okay if you don't see a lot, right? That's where the whole numbers come into play. If you don't see a lot on your chart when you go to a daily and a 4-hour, that's fine. You're not going to maybe spot everything. Same with me. Like, there's not all the time where I spot every single key zone. Sometimes they go by you, sometimes they go past you, and you're like, man, how did I miss that, right? That's the truth in trading. So you're not going to catch everything, but a key way to start, whether you're on gold or even something like a currency pair, like Euro USD, going to a monthly, you're not going to get much. You can pretty much start out on a daily and 4 hour for the most part through your days to mark out key levels of support and resistance. Areas where you see price rejection, now we kind of want to look more above us in this case. Here's a resistance. What we can do when we mark off a few key price levels that we see some rejection off is put the rectangle tool around them to create that zone. All right, we can create that rectangular zone around these levels. And this is what I like to do when I'm marking my charts up from the top to the bottom, or I'm zooming out and looking for other key levels, especially and mainly with gold. We can do all this stuff on any pair, but the main thing I like to do it on is gold. And honestly, one of the main things I like to use is whole numbers, the round numbers, to mark out my key levels. One of the key ones that we mark with gold is every $25. So if I put a marker at 3,300 on gold, and then I put another marker at 3,275, these are quarter levels. So this ties into support and resistance. Every $25 and every $10 and every $5 is a whole number on gold. I'm going to show you guys one example of this in this video with the $25 levels, because there's a lot that we could do and talk about with this exact topic. We could literally make a 2-hour video just on this exact topic every single day of the week, because it's something that we focus on every day. So what's a whole number? A whole number is just a rounded number at the zeros, okay? It ties into what we're talking about with this part when it comes down to support and resistance. Gold tends to respect levels that have 10s and 5s in them, and also 50s, 75s, 25s. These psychological levels often act like short-term support and resistance. I'm going to show you a few examples here on gold with the $25 levels. If you guys want to learn more about the other levels with gold, the $10 levels, the $5 levels, and so on. So this is what I like to do around my key levels, around my whole numbers. Remember, a whole number is a zero. It's a rounded number, just like this, 3,200 and 3,300. We have 3,300 there, so $3,300. Down at the bottom, we have $3,200. We could go down a few more times to 3,150. So notice all I'm doing is separating the chart $25 apart from each horizontal line. And the horizontal line is one of the first things we talked about in this video when we were talking about drawing tools. And you can see there's different ways to draw it. We don't just have to use a horizontal line based on what we see. We can draw them on key price levels, okay? And that's how we like to draw these zones. So let's go over an example. If you look at 3,175 and 3,150, you can see how the price rejects those levels, creates some support. But one of the levels that might stand out is 3,250. You can see some resistance there, and then the market pushes down. These are also very, very important whether you're trading currency pairs or gold. Plug into the YouTube's live daily to learn about this concept, guys, because this ties into support and resistance. I'll show you on a smaller time frame chart where we were before. Like over here, for instance, when we look at gold, we can see there was a support here. What did the market do? It rejected at this level. What does rejection mean? That's when we're talking about the candlesticks closing bullish or bearish. So support and resistance is the bread and butter of trading, or one of the ingredients in trading. If we were going to say trading is like a big cake, there's different ingredients that go into it, but there's different ways to view support and resistance. We can view it in the candles. We can use key price levels like whole numbers to help out, kind of create a grid on our chart. And we can obviously use our eyes for what we see where there's multiple reactions on the chart. Now, if we look at gold here, we're going to talk a little bit about support candles. That is when you get these tiny rejection candles after a strong bearish move or a downtrend. Rejection candles are typically a sign that the trend is shifting and the market is either gaining strength or weakening, depending on where these rejection candles come from. Typically, after the market's made a strong move, bullish or bearish, it will find its high or it will find its low. A lot of times the market's going to form some rejection candles. Those can be early signs of sellers or buyers stepping into the market to reverse the price. If you look at gold, it had a big dump here. And what did it do? It dropped for quite a bit, and then it had a really big rejection candle right here. After that, the market started to go in the upward direction. But if we look in this area, this is a good example of rejection candlesticks. It could be that first few candlesticks that reject a certain area or start to reject a certain trend. So we can see gold here pushing up, and we can see a rejection candle here starting a bearish move. Now, what can we tie into this is whole numbers. Because if we put 23.25 here, there's rejection at the whole number around that area. That's why I like to do the zones, because it creates more of an area around the price. So if you look at 32.25, what happens at that price? Rejection. What do I mean by that? It's the candles slowing down after this bearish move. They're going a bit sideways, smaller. So this is rejecting right here. So it's when you have, say, an area or a downtrend, market's coming down, and you get that bullish rejection. It could be that green candle. Simple terms, you could have a support just rejecting at a level, a bullish candlestick close. Something like this one right here, or even to the right. When you look at gold, you could see another rejection candle right here. And you can see how the market rejects here. Support is like a floor. So support is like a floor, right? The market can form a floor and it can bounce. The candlesticks can help us show the beginning of that. If we have a red candle coming down, we have another red candle coming down, we have another red candle coming down. The trend can shift after you get that green candle of rejection. This is one of the signs we like to focus on, especially when we're scalping the market, because it's a sign of rejection that the trend could be shifting and that the trend could be over. So rejecting is wicks. When you see these wicks, it means the price is rejected. The bodies closing is more confirmation. So you can get like wick rejections, but no body close. So when we're talking about the candlesticks have these wicks on them, right? These wicks can be big at times. For example, there's a really big candlestick wick right here to the right. That's a wick. Wicks show rejection. The next candlestick closes bullish. That shows more confirmation. So you can always get these wicks that reject price. That is a good sign and a good signal that price can be reversing. Candlesticks closing are more of the confirmation for the trade. So one of the pro tips for this video, guys, and what we're going over here is to use areas and to use zones, not just itty bitty little thin lines, because the market can be volatile and form wicks around these price areas or even support. For example, you can see here at this low, what does the market do? It wicks below it. You can see that big wick to the right here. What does that wick do though, right? It's pretty volatile. It's at a key price level. It's at a $25 level. It wicks down, but it rejects. So it shows rejection in that moment. The next candlestick is more of the confirmation candlestick that goes bullish. So what I would say is focus on clean, obvious zones. Don't chase every single zone. Don't try to fit every single zone to make it perfect. Chase the ones and focus on the ones that you can see that are clean and obvious to your eye. And a pro tip also would be to, again, to use zones and areas. Kind of think of the market as in areas, because a lot of times when you create even just a support here, you can see there's like an area of support. It's not just one straight line. So you can get that a lot in the market. That is completely normal. So break and retest. What is break and retest? This is a really good concept in trading. It's when the market breaks through a resistance or breaks through a support. So breaks through our ceiling or breaks through our floor. This could be in an uptrend or a downtrend, or even a market that's getting ready to reverse out of an accumulation phase. We have an example here on the EURUSD of a break and retest on the 4-hour chart. You can see this area here that I have marked with the green zone. So we could see at that green zone that there's a clear sign of resistance at that level. Eventually there's a big engulfing candle that pushes through that level and pulls right back to the zone, creating support at that nearby resistance while the market's going up. If we were to zoom out and go to a daily, we can also see a resistance right here on the daily that gets tapped. So notice this, I have two different areas drawn on the chart here for the EURUSD. I have right here, and we can see the level that the market forms a resistance at here. Stretch it over, nice resistance, turned into support. This is called break and retest. It's when you find a resistance that turns into a support. That's what happens here. But if we go to a 4-hour, we can see even another one like right here, all in this area. So there could be different areas on the chart where this forms. It could be in a downtrend where the market has something like this. Or even right now, if we look at the market, you can see there's a resistance behind us right here where the candles close. So even pulling back to that resistance would be like a break and retest of the resistance level. So what I would do is go mark support and resistance on two pairs, one Forex, one gold, or two Forex, one gold. Make it clean, don't force it. Start in the daily, start in the 4 hours, start in the 1 hour. Stick to a few pairs for a little while and practice drawing support and resistance levels like this and study what you can see on the chart. See if you can find anything like what we've gone over, like break and retest. Usually break and retest happens in a trend, and you can see the market is in a trend here. So ideally it would be we're looking for the market to pull back to the resistance or the broken level of resistance for a break and retest. If you're a new trader, what you want to understand is how the market operates on a 24-hour basis through the days of the week and the Forex trading hours. The market operates on a 24-hour basis, and there's different times of the day where different sessions are opening in the world. Like the London session, like the New York session, and like the Sydney, Australia session, and Tokyo session. These are times where volume starts to come into the market. And as a chartist, as someone who's doing technical analysis on Tradingview, you want to be familiar with this stuff. You might be living in Europe, or you might be living in USA, or you might be on a time zone that's in Asia. Wherever you are watching this video, you have to understand there's different parts of the world that the market starts operating and opening, just like where you live, right? A lot of you guys watching this video might be living in the US. So when your day starts, it starts at 8 in the morning, maybe 9 in the morning, right? When the banks open and everything starts opening up, 7:30, 8:30, 9:30 in the morning when it comes down to the US, right? The same thing's happening worldwide, right? In London, in Europe, right? 8 a.m. for them is 3 a.m. for me. So London session for me begins at 3 in the morning because I live on the Eastern time zone. I live on New York time zone. So for me, London session, which is the European session, right, begins at 3 in the morning. New York session starts at 8 in the morning, 9 in the morning. You notice a time where London session and New York session overlap each other. This is called the overlap of London and New York. So most of you guys watching this video are probably at the basic level of trading and learning this new language of the market and how to do technical analysis and spot setups in the market. That's why in the first hour, we went over a lot of the basic everyday things that you're going to get used to doing naturally as a trader every single day when you're on Tradingview. And before you learn how to identify and spot setups in the market, you want to learn all those basic little tools and all those basic little things because you're going to use them every single day. So everything that we went over in the first hour of this video is all the basic little things that you need to practice and do every single day to just become better and gain repetition on the charts. More time on the charts, more time practicing technical analysis is repetition. So you're going to get better over time the more you do these little things. In this part of the video, guys, we're going to be going over more inner stuff, a lot of inside information that I share inside my inner circle to help you understand more about how we identify and spot setups. I'm going to give you more value in this part of the video on real things that make me real money in the market, and I'm going to show you real examples from today and the last 24 hours. Today I was doing a live stream and I was analyzing gold. What we do a lot of times in the market is wait for setups. We're not always trading the market any given moment time of the day. There's a lot of things that we focus on outside of all the things that I taught you guys in the last hour, but we can tie some of those things in together, and I can share some of that information with you here to give you guys a better understanding of how we spot setups. This is the type of stuff that I share inside my inner circle pretty much on a daily or every other day basis because I'm always looking for setups on gold throughout the week. This is an example from a live stream today. We were waiting for gold to pull back. Gold was trading up with a bullish market structure. As I've already taught you guys a little bit about market structure when it comes to uptrend movements and downtrend movements. At a basic level, we can look at market structure with the market making lows and highs, higher lows, higher highs. So we can see here a market structure, an uptrending market structure. This is something that I explained in the first hour of the video. This is something we talk about pretty much every single day inside my inner circle because market structure, like I mentioned before, is again your skeleton to the market. It gives you a good framework of where the market could go and what it could do next. Here, I'm basically identifying market structure for myself. I'm looking at the current market structure and I'm saying, okay, I see some bullish market structure here and I see that price pushed up and made a higher high. So what am I thinking? I'm thinking this pullback could take me potentially into a higher low. And another thing that we can look over here and see, this is around 3,300 and 3,305. Notice where I'm drawing my arrow back to. I'm using those key psychological levels, the whole numbers. That's something I explained in the first part of this video, right? Is whole numbers and round numbers are key in trading. We like to focus on them with gold. Inside my inner circle, I teach about whole numbers every single day, every single week, and we have a whole classroom section of videos from previous examples and examples like this that I'm currently making videos on, kind of like this that you guys are seeing, right? This was live and I did this live. You guys can actually go back on my YouTube and see the little part where I'm analyzing this live and see what I'm doing. I do this every single day inside of my inner circle. Now, what I'm looking at here is a pullback. I want to pull back to this area because I understand the market is likely to make a bullish reaction off of this area with the candlesticks. I'm using the psychological levels, the key levels, to also give me an idea of where the market could pull back to. Because remember, like I said, key levels pretty much work like magnets. Price gravitates towards them. So I'm looking at the key levels to see where price could pull back to as well. I'm using those. Not to mention, look at what I like to call this cluster of candlesticks here. Look at this action of price action we call it. There's a little bit of action in here, something we would call supply and demand. That's a bit more advanced topic, but I teach it inside my inner circle and it's a topic that's inside the classroom. There's a little bit of what we call a little cluster here where something we call volume pushes up, all right? Something you can understand from here is this little cluster and where the market came from brings in volume. So really, I'm looking at the market pulling back here. Now I want to show you what gold did ever since then. That was one, and this is where replay mode comes into hand. I can show you guys with replay mode what I was looking at here. So I wanted gold to pretty much pull back, and you can go on the live stream. I'll actually show you again along the way. I'm analyzing this the whole entire time. I'm saying if gold can come down to 3305 or maybe a bit lower, we could have a reaction around that zone. This is from time and time again of spotting the same setup because the market is kind of like me and you. us humans. It repeats its tendencies, it repeats its pattern. They like to say history repeats itself in the market. So this isn't something that's new to me. It's familiar. This is a way that I like to spot certain setups in the market. It's cool because you guys can go back on my stream and I record every single inner circle session, so all my inner circle students can see every session before and after. And I always like to record my trade breakdowns like this one. You can see what I'm looking for here. A pullback to 33.05 for the next move up in that market structure. I'm expecting a next leg up to create possibly another higher high or a push up. And this is what the market did. So all I was analyzing on that session again was a combination of those things that I've gone over. Here it is right here. Shortly before I got off the stream, kind of like the last markup I was saying, again, just wait. This is what we do as traders. So let's go over some mindset as well in this video for you guys. Let's talk about some mindset. All right. You get paid to wait in trading. We like to say it's good to sit on your hands and let the market come to you. The most paid traders are usually the most patient traders, right? Patience, right? Patience. We can say patience pays you in the market. A lot of times we have to sit on our hands and learn this discipline of patience. Not every trader has that type of patience to wait. That's why a lot of traders are not successful in Forex trading, because they're not patient enough to wait for the market. They get something called FOMO. It's the fear of missing out. It's knowing price is going up or watching price going up and you're not in a trade, and you want to be in a trade because you're fearful or you're worried that the market's going to go up without you or down without you if you're in a sell, right? So that's what FOMO is, right? You need extra patience in the market to wait for setups to come to you. You have the ability to do that, to let the market come to you for certain setups and give yourself a criteria. It's not random decisions that we make in the market. We're typically trading things that we've traded before. Patterns and setups, we like to call them, that we've traded before. This is an example of me waiting for the market to come back to a certain area. So staying patient so I can catch a trade, so I can catch a possible entry. And this is what gold did afterwards. It came right down. So this is replay mode. Replay mode's really cool on Tradingview. It's not a feature we really talked about in the first hour, but I can use replay mode here to show you guys how it works, right? Tradingview, like I said, you have those free accounts, but this is one of those features that is on the paid account. So I'm going to go through replay mode real quick to show you guys. It's kind of like fasting forward and replaying the chart. There's a little forward button down here, and I basically just rewinded the chart, and this just simulates price action, goes forward, right? And you can see now the candles are acting, and then we got this dump down. We got that fast move down. Notice I'm on the 5-minute chart right now, and you can see a green candle appears there. 2 green candlesticks now appear there, and then another candle comes down. But what does the market do shortly afterwards? It pushes right up above this area. So you could see it's not perfect, and I mentioned something in the past hour about how I like to create these areas around price, these boxes with the rectangle tool. So if you guys remember, and if you guys have been taking notes, because this is stuff you'll remember, take notes of everything I said. If you're inside my inner circle, these are all the things we practice and all the things you'll get good at understanding quickly. If you spend 2-3 months with me on the charts, you will learn a lot in that period of time. And if you have lifetime access, all you need is a couple months with me, and you will literally learn so much about the market, on how to identify setups, and just having the right and proper mindset of a trader. I myself have been trading now for over 10 years. So I've spent a lot of time on these charts developing the right disciplines and characteristics of a trader. It's not always the charts. A lot of it is discipline and psychology, we like to say. There's a lot that goes into our human characteristics, like our emotions, our fear, our greed, and different disciplines we have to create around ourselves as a human to become a proper and profitable trader, a consistent trader. We don't only have to be consistent in what we know on the charts, but consistent in our own disciplines, okay? That is why I like to draw the zones. Remember what I said maybe over an hour ago, a little bit over an hour ago, guys, with the rectangle tool, right? I like to draw these zones because the market kind of works like areas for support and resistance. It's not just one price point. So we can use whole numbers to kind of give us an idea of, okay, 3305. You can see I'm saying 3305, and if you go back on that session, I was even saying maybe 3305 or a bit lower the market could go, right? That's why I like to draw what we call zones. As we've talked about, support and resistance kind of works like areas and zones. So you can see 3305 here, respected price, and it gave a nice push up. And that was it. The next pullback came very closely back to it, and since then the market has gone up a little bit. That was one of the trades that I caught not that long ago as I'm recording this video. This is where the live market is. I was in this trade. All right, for anyone who's experienced already, you know what MetaTrader 4, MetaTrader 5 is. It's a platform that we use to trade off of. For anyone who's new, this is the platform I think is good to start off of and learn how to trade the Forex markets or other markets. It's the platform I started 10 years ago. It's really simple. It's a platform that we trade the different markets off of to make profit in the markets, right? You guys ask me a lot and people ask me a lot, what do you trade off of? What do you trade off of? I like to trade off of MT5 or MetaTrader 4. Most traders that you're gonna see at a high level that are using maybe even other platforms, they all started here. Everyone I think in the retail world, so retail meaning people who trade from home like me, that trade at maybe a home office, they mostly use a platform like MT4. MetaTrader 4 or MetaTrader 5 is a platform that allows us to enter the world of trading. It gives us many things to start off with, like all currencies, commodities like gold and silver, indices like the S&P 500, US 30, and even your cryptos like Bitcoin and Ethereum, in which it provides us all the graphs and prices for each one of these things that we can trade in the markets. It gives us also different options to act by different market orders, like a market execution, which is at the current price. So we can enter the market right here, right now, at any time, as long as the market is open. Forex is open 5 days a week, 24/5, from Sunday, Monday open until Friday when it closes, whereas the crypto market is 24/7. So you can enter the market at any time, but there's different types of orders that you're gonna notice and different types of options and things that you have to get kind of accustomed to when you're starting out with MetaTrader 4. So if you're an experienced trader already, you've been trading for a couple years, you're gonna know this information. Maybe there's some little mindset stuff in this video I can help you guys understand more. But this is pretty just much a basic educational video for you guys that want to understand the platform we trade off of, the platform that we make money off of, which is, again, it looks like this on the phone. So it's easy to download on the phone. I trade still off of my phone. I'm used to this, and the reason I still trade off of it is because I'm just so used to it, and it's really simple. I've tried other platforms, and other platforms do have a lot of other features, but I don't really need all those things. I just need Tradingview and then this. I mainly don't even always look at my trades. I'm mainly looking at Tradingview. I don't always like to watch the profit go in and out of profit. I mainly like to keep an eye on price on Tradingview. So Tradingview plus MetaTrader 5, good combination. I want you guys to understand that are new in this video, the different types of orders that we have on MetaTrader, because some of them are going to be really, really useful for our trading strategies, especially with gold when it comes to something called limit orders. Limit orders is something really, really useful when it comes to trading gold, because we have a whole number strategy with gold that works really, really well. People ask me if I use limit orders. I do for one certain strategy, and only on gold if I'm gonna sell it or buy it at a specific price using whole numbers. It's a really useful tool if you're not gonna be on the charts, but you have a setup that is setting up in front of you as well. So what is a limit order? We have something called market execution, which is if the price is where I want it to be and I have a setup, I can enter right now. Market execute at the current price in front of me. A pending order is something called a buy limit. So a buy limit is a pending purchase order where the price has not reached. The moment the price reaches where the purchase limit is, MT4 or MT5 automatically enters the trade or enters the market without you having to do it, without you having to push buy, right? Or sell on your app, on your phone, or on your laptop, right? This is how technology has changed over the years in trading, right? We can put pending orders. Say we want to buy something at a price that the market hasn't reached yet. We know if it comes to this area, there's probably going to be a move up, right? This is a strategy we can use in the markets if we're not always looking at the charts, or if we're even sleeping, if we're not going to be looking at the trades the whole entire time. This is a key thing to understand, especially when you get used to the charts and you learn market structure and hold numbers with gold. So it's basically going to do the job for us, especially if we have a setup. Sell limits are the opposite of what I just explained in the market. It's basically a pending sell order in which the market has not reached that point. But the moment it arrives, MT4 automatically enters you the trade without you even having to do it. So if it's a high price that we're trying to sell the market at, or if we know the market's going to go to this price and fall, we can put a pending sell limit order at this price, typically like a resistance level or a whole number is what I like to use for gold. The only way I use limit orders is when I'm trading gold for whole numbers. So some of you guys that are experienced, you can maybe get this part out of this. I use pending orders, and we're gonna talk more about how I use them in advanced videos. I'll usually use sell limits a lot. I'm good at using sell limits and then buy limits for certain setups on gold. I'll use sell limits a lot when I know there's a setup setting up in front of me and I wanna get a higher price. I'm trying to catch around a whole number like 2720 or 2725 or 2700, like a round number that I know price is likely to react at when it comes to there. I'll place a pending order and I'll watch the 5-minute chart. I'll watch the 5-minute chart when price first hits that whole number. So I do use limit orders. A lot of people don't think I do or don't know I do because I've never taught anything about it. There's a lot of things that I haven't taught out there. There's a lot of secrets and tips and tricks that I'm gonna be able to share with you guys more inside of this academy. I'm gonna show you guys results. I'm gonna show you guys experiences and share these things with you inside of here. So I do use limit orders. A lot of people ask me if I do or don't. So another thing that MT4 and MT5 has, aside from pending orders, different order types, are 2 other tools that you're gonna wanna learn and understand. These are terms that you've gotta understand as a trader. If you're a new trader, let's just picture your first month or 2 in the market, in the academy, as I'm a beginner. I'm in the bootcamp series. I'm in more of, I gotta understand the foundation. I'm building the concrete, right? I like a house, right? You're building that foundation, you're building that concrete. So you gotta go through all the boring stuff first. You gotta really just beat at the boring stuff. I like to call it the who, what, where, when stuff. It's kind of the boring topics, like what is this? What is this? How is this? Who is this? Like, how is this? Learning the language, right? These are terms that if you're a new trader, you need to learn. If you've already been trading for some years, you know how the stop loss works and the take profit works. So for all these basic videos, guys, these are terms you're gonna wanna study, because when I'm on the live sessions, right, I'm gonna be talking about all these things. I'm gonna be doing basic sessions and more advanced sessions. So when I'm on the live sessions, I'm gonna be talking about stop loss, or where we put our take profit, where we could put a stop loss, guys. When we're doing live analysis, for instance, we're gonna be doing live analysis sessions. So I'm gonna be like, guys, this is a good place to put our stop loss. So I want you guys to understand what a stop loss is if you're new, or what a take profit is if you're new. For those of you guys that are experienced, you're gonna get a lot in the advanced section and in the step ups from these videos. There's a lot more basic videos coming your way that are more advanced, and then there's a whole advanced section that's gonna have a lot of content in there. But our live analysis sessions that go every day, our live education sessions that go every single day, that's where you're gonna learn a lot more, where we're gonna turn the volume up. So for those of you guys that are new, your first 30 days, your first couple weeks, bang out these topics, study them. What is a stop loss, right? So let's talk about the 2 things here, stop loss and take profit. The stop loss is a preset price level where your trade will automatically close if the market moves against you. What it does is it limits your loss on a trade to a specific amount, helping you avoid larger losses than you are willing to risk on a trade. So this is important because we're gonna talk about this in mindset videos. This might sound like, whoa, losing, I don't wanna lose, right? No, trading, it's important to understand stop loss is a crucial tool that limits our losses. It's a predetermined set tool that we can use to say, okay, if the market goes here, I'm wrong, right? If the market goes to here, I'm wrong. And this is where I'm gonna put my stop loss in case I'm wrong, in case the market goes against me. It can limit our losses. We can set a stop loss to only lose $10 on a trade. We can set a stop loss to only lose $20 on a trade. We can set a stop loss to only lose $5 on a trade. We can put our stop loss in literally any amount of money we want to risk on a trade. Whether it's $100, we can set our stop loss to predetermine that. That's the mindset of a trader. So the mindset of a trader is accepting risk before they take a trade. So risk management is key. In our mindset and risk management videos, you're gonna hear me talk like this. The way I'm talking right now, we're gonna talk a lot about that and the stop loss, why it's important in those videos. When you open a trade in Forex or in anything, you can specifically set your stop loss on the platform. And when the market goes there, it'll automatically close the trade if you're not looking. You don't always wanna be looking at your trade and glued to it like, oh my gosh, what's happened? You don't wanna look at your trade every minute, like what's happening every 5 minutes. That's an emotional trader. That's more of an excited trader or a feel-for trader or a trader who's giving themselves anxiety, right? You wanna be able to go to a trade setup and say, this is what I'm risking and I'm okay with any outcome. Win or lose, doesn't matter because I know my strategy works over time. If I take 100 trades and I win 60, that's good. That's good in the business of trading. If I win 60, 70 of my trades, I have to make sure those 60, 70 winners are bigger than my 30 to 40 losers. And I have to be willing to accept the risk and the outcome ahead of time. This is why setting a stop loss or understanding risk management is key. So it can be placed below or above our entry point. If we're buying the market, we're putting a stop loss below our entry point. Take profit is basically kind of like the opposite of your stop loss. It's a price level where your trade will automatically close once the market goes in your direction. So it locks in profits when the market has reached a desired level, ensuring you capture those gains, especially if you're not monitoring the charts. There's been a lot of times where I'm in a trade and I'm not looking and it goes to a level and then reverses and I missed out on closing the trade. So having a take profit set at a point that you think the market should reach, not that you're trying to look for too much, but you think the market should reach and you're not always looking at the chart, you can set a take profit on your platform and the trade will automatically close for you. This is kind of how things look when it comes to like limit orders, like a buy limit or a sell limit. A buy limit is an order placed below price and then it goes up, it fills your order when it reaches this level. Let's say you're trying to buy at a support level or an area where you see the market has a lot of candlesticks rejecting. You want to buy when the market comes here, but you don't really know when the market's going to get there. It might take hours, it might take a day for the market to get there. What if it takes a week for the market to get there? What if it takes a whole entire sleep, right? Maybe it takes 8 hours. We sleep for what? Usually 6 to 8 hours, most humans. So when you're sleeping, you might have a good setup and you want to buy when the market's here and you're not, or you're at work even. What if you're at work for a good duration of the day, or maybe you have a setup, or you're just not on the charts in general, right? It might take the market some time to get to this support. So you can place a pending order there. So when it does, it will trigger your trade. So this is a buy and sell limit. Another type of order we have on MetaTrader 4, which I don't use at all, like literally at all. I just kind of understand the flow of this. It's important to understand buy stops and sell stops. There are other types of orders that will automatically enter the trend if it crosses a selected price, if the market goes through a selected price. Scalpers or like momentum or breakout traders usually use buy stops and sell stops. Understanding the concept of buy stops and sell stops with liquidity and stop losses, I think are really, really important, but I don't use this type of order at all. I never really actually have. It's usually used in like news events or a time where you know there's gonna be like high impact and momentum in the market. I'm not really a buy stop, sell stop trader, but it's looking to lock in like a breakout above a price or below a price. There are a lot of traders who do use buy stops and sell stops. I don't. They might be the type of trader who sees a resistance level and they understand the market's likely to break out the resistance, so they put their buy stop above the resistance because they know when the market's gonna push through, it's gonna grab those stop losses that are at resistance. So understanding like the concept of who uses buy stops and sell stops is important, because people like me, maybe from home, don't really use them a lot, but the big institutions do. the smart money does. This is a more advanced topic when we get into the topic of liquidity and understanding order flow in the market and stop losses, right? Because there's a lot of people trading the markets and there's different entities in the markets. We talk about this in another video. There's a lot of people like us, but then you have hedge funds, central banks, right? Governments, you have these big entities that trade the market, right? So buy stops and sell stops, understanding how they affect price can be an interesting concept that we can go deeper on, guys. But what we're gonna talk about now is Forex market sessions. Anyone who's new needs to understand this topic. If you're an experienced trader, we're gonna talk about some things that you need to also understand in the next video where we go over Forex market sessions. All right, guys, so I'm on my phone right now and there's a lot of apps that I have on my phone. I really don't use them all. The one that takes the glory is MetaTrader 5. That's the app that I spend the most time on. I got Instagram, I got all those apps like probably you guys have, but me, I'm locked in on MetaTrader 5 every day. This is the app that we make money on in the markets. This is the app that I'm trading off of. And I'm just gonna kind of show you guys here how it looks, how it works, right? You can download it to your iPhone or your smartphone device, right? It looks like this. The market's closed right now, so nothing is moving at the moment. The prices aren't fluctuating except for Bitcoin. That would be the only thing moving at the moment because Bitcoin's 24/7, whereas currency pairs are open 24/5 or gold is open 24/5. So you have your basic currency pairs here. Now, I can search any symbol like the AUD USD or let's say the USD CHF here, and I can add any currency pair to my watch list here, right? I can add anything that I want to look at here. You can see I have all the currency pairs that I mainly look at and the charts that I mainly look at. There's a little icon here in the top right corner where you could take everything out. Like I could take all of these out and just make it one pair. If I just want to go lock in, dark mode, Batman mode, literally gold, just got gold there. If I just want to lock in, like don't look at anything else, no distractions, that's it. That's all I'm looking at. It's the only price I see. So you can see I put gold there. If I want to enter and search a symbol, I can add them all here. Like I can go to the majors, I can go to the minors, I can go to a major currency pairs and add Euro USD, GBP USD, AUD USD. So you can now see my watch list here has the different pairs and I can check up, keep on their different prices. If I want to go to the chart, this is the basis of the chart right here on gold. We're looking at gold, we're on a 1 minute chart at the moment. I can change the time frames here. And I like MetaTrader. You can see I have a lot of horizontal lines on my chart because I'm always marking up the prices. I'm always marking up the whole numbers. For instance, on this, I'm using the tools here. There's different tools at the top here. There's like these three little icons. There's like a crosshair and then there's this F. This F is where I can select different indicators. But then there's these shapes here. Honestly, the only tool I use is that horizontal line, just like on Tradingview, but I like to keep an eye on my prices because I'm not always on Tradingview. I can quickly just kind of pull up MetaTrader and literally see the prices. Like I can watch it and I'm a scalper day trader, right? So once you become accustomed to watching price more and you have a couple months spent watching the markets, you'll know kind of like what I'm talking about of like, it's quickly to just pull up your phone. Okay, let me see where price is at. Okay, instead of logging in your laptop, having to do analysis. So it's really quick and easy to go through the time frames here on MetaTrader 5, especially if you have the iPhone here. Like I'm on the iPhone. I think MetaTrader 5 with the black screen has the candlesticks really clear. Like the candlesticks are pretty clear with their closes, with their confirmations when they close. I like the way with the black screen, how the candlesticks look really clean and flush. I find as you spend more time looking at this with the black screen and the candles, you spot rejection candles a lot more clear. So I literally like to mark like my whole numbers like 2720, 2715, 2710, 2705. I like to do the same thing I show you guys on the live sessions with Tradingview on here. As I see maybe price moving in a direction, as I see price trending, I like to keep an eye on the whole numbers here. So I literally just kind of put like every $5, 2700, 2705, 2710. So I even do like analysis on this and kind of keep an eye on like where the price is at. It's easy to do that. So let's talk a little bit about some of the stuff we talked about in our other video with the lot sizes and orders. Like if you look at this circle here, that's red and blue, That's where we can do our pending orders, like a buy limit or a sell limit. So for instance, right now, this is why I like MetaTrader 5 more than MetaTrader 4, because you can do this really easily. So I'm gonna delete the horizontal lines before I do this. So this little circle here, when I click it, it's gonna activate the buy limit. The buy limit gets activated. It's basically like an option for the pending orders. If I take that, I can move it. It's pretty cool, I can move it. If I move it above price, it's now a sell limit. If I move it below price, it's a buy limit. So we talked about in our last video about sell limits and buy limits. Let's say I was looking for a trade at 27.25. Let's say I think if gold hits 27.25, right? I'm gonna put a horizontal line around 27.25. Let's just say I think if gold hits 27.25, I think we're gonna have a sell there. I could place a sell limit at that price ahead of time, and I can go to where this little arrow is. If you look at where it says sell limit, there's SL, TP. So I can actually add my stop loss and take profit to this. It's pretty cool what you could do on MetaTrader 5, like really quickly. If I put an order, let's say I'm gonna go to a sell limit, right? And I'm gonna put a sell limit at 27.25. Now, that's gonna be where my sell limit is. I wanna put a stop loss. I have to click SL. My stop loss is activated. I can put my stop loss, let's say I'm gonna put it at 27.30. I can see how much that is worth with my lot size. See how I have an 0.005 and I have 504 points? That's 50 pips basically when you consider it, because if we look at how much it would be worth in value, I'd be risking $25 on this trade. 5, 10, 15, 20, 25. So I'd be risking $5. That's an 0.05 lot size. That's half of a 0.1 lot size. If I was risking a 0.1, it would be $50. If I was risking, let's go. Let me show you, let's change the lot size for instance. Let's go sell limit at 27.25. And let's put my stop loss at 27.30. So the risk would be about $25, $22 if I was doing that. 45 points or 450 points. If I change the lot size though, let me change the lot size. See right here, there's those two icons right there, the circle and the rectangle, right? The rectangle is the quick trade market execution where I can change my lot sizes here. If I want to put this to like a 0.4 lot size or maybe a 0.6 or a different lot size, I can change it here. Let me show you how the value would change. See how I have 001? At 450 points, let's change it to 50 points, at 500 points. So I have 001. Remember in our last video, we talked about the lot sizes. An 001 is the smallest you can trade. So that's $5, that distance is $5. If I take this, see the 001, it moves in pennies or like 10 cents. It moves in like 10 cents to dollars. It moves in the tens of cents, let's say. Because it would take to lose $5 for the market to go up here. Gold's pretty volatile, moving fast right now. So it's not the hugest distance on gold, but it's a decent distance for $5, right? If I change this to 002, it's gonna show $10. See, 002, if I were to change that lot size to an 002, let's go sell limit at around 725. I'm gonna put our stop loss around 27.30. Now it's $10.40 risk because I have an 002. Right, the 002 is gonna move more in the cents, right? If I drag this up and down, I can see the dollar value, right? Let's do take profit. If I click on take profit, it's gonna activate a green line. So if I have a take profit and the market comes all the way down here, I can make $50, right? See the difference between, okay, my take profit is the green level. I'll put my take profit, let me put my take profit right here. So I'm gonna be risking on this trade $10 to try to make $30 on this setup. For example, if the market hits my sell limit, I'm gonna be activated at an 002. My stop loss is gonna be $10.62. So I know the most I'm gonna risk on this trade is $10.62. The most I can make if it hits my target is $30 on this trade. So that's a good risk to reward, something we call risk to reward, because we wanna take trades that we're willing to risk less on to try to make more on.
For me to get up to what I'm risking, and we're gonna talk more about risk to reward, the market would need to go here. The market would need to go around 720 for me to get that same 1048 back. If I wanted to just get what I'm risking, what I'm willing to risk, the market would need to go here based on my lot size. So our stop loss is like a measurement of our take profit in a way, right? It could be a measurement of, okay, like if the market moves in the equal unit of my risk down in my direction, then I'll be up how much I'm risking. We're trying to get maybe more than what we're risking though. I want to try to maybe risk $10 to get at least like maybe around 20. I think if I risk $10 and the market comes here to 20, that's a pretty good risk to reward. $30 would be great because I'm risking 10 and I'm making 30, right? So if I win 6 trades and I lose 4, what I want you guys to do right now is take a piece of paper, for instance, and let's say we take 10 trades and we win 6. The 6 of them are $30 in profit, but the 4 that we lose are gonna be $10 of loss. Overall, if we do the math on that and we go to our calculator, for instance, so if I'm winning 6 trades, but my 6 are around $30 profit, I've made $180 profit, right? But if I'm risking $10, right, on the 4 that lose, right, I've lost $40 total. So what's 180 minus 40? 140 bucks. So I'm $140 in profit. Out of 10 trades, I took 6 wins, 4 losses. Is that the best? Might not seem like it's like, oh, 10 out of 6, it's not 100%, it's not 90%, it's not 80%, it's not 70%, it's 60%, but it's still profitable. This is the way you need to think, right? We want to be willing to risk to try to get more. We want to make sure our wins are bigger than our losses, right? Let's take it a step up for a little bit. Let's say if I go to a 0.1, it's gonna really change now. See, a 0.1 is now $53 risk. Now it's $53 I'm willing to risk on there. It's changed quite a bit because I went from an 0.01 to a 0.1, right? The risk now in that same distance is about $50, right? So the risk now is 50 bucks on this trade. If I'm gonna put an entry at 27.25 and I don't think it's gonna go to 27.30, I'm gonna put a 0.1, risking 50 bucks in this distance now on gold. Let's put a take profit. If I drag this down, we have a take profit. Now the take profit though, if the market comes to here, that's 100 bucks potentially profit. If the market comes down to here, that's $200 profit. So I'm looking to take trades with this kind of thinking, like, okay, can I risk 50 to make 200? Can I risk 50 to even make 100? Even if 100, right, because that's double, right? My loss, if I'm losing that much every time, my wins are still greater, right? If I'm catching that type of win or if I'm planning around that. So it's key to understand lot sizing, right? We can change the lot size here. I can go to an 001, I can go to an 002, 003, 004, 005. I can change the lot size and see every time I change it, like 006, and I click, that risk will change. If I go really big, if I go to a 0.5, it's half a standard. That's really big risk now. Now we're getting a lot bigger. So what would I would do if you're a new trader, whether you're trading Euro USD or currency pairs, start off with the 001. Start off with the 001 and get used to like the pennies and the dollar moves. Like, okay, because any move could be worth X amount. Like there's traders who are trading with $100 accounts, small accounts, probably where a lot of you guys might be small. So you want to get used to like the dollars, the small. You want to be risking like maybe $3, $5, $10, $20 trades, right? Not a whole lot, but you want to be trying to get like $10 gains, $20, $50, $40 gains, right? Bigger than your losses. Increase of capital and putting on risk is key. Just understanding that. I'll show you the history, for example. This is on one of my accounts from this week. And all I was trading was gold on Friday. Friday, I put some money in an account, took some L's, bounced back here. I was trading a little bit of USD CAD. So you can see here, or scroll down where some of these bigger trades are. I'm trading with bigger units. I'm taking a lot of trades or different entries on the same setup. So I'm trading with a half a standard lot on some of these setups. So a half a standard lot, that's gonna be a big position if you're trading on a small balance, guys. That's a pretty big position, especially with gold. Gold's volatile. You can make $250, $500, $1,000 on that position. If you're scalping, it might look something like this. I'm getting in and out of positions quickly. So you can see the lot size, like here, for instance, 250 bucks from 27.13 to 27.08. That's 50 pips. That's pretty much like catching 50 pips right there in the market. Every 10 pips would be worth 50 bucks, or every dollar. So gold, how we look at gold basically is every dollar is worth 10 pips. A dollar on gold, if we're trading at the smallest, think about it like this. An 001, every dollar on gold, on an 001, if price moves a dollar, you're down a dollar. That's the most. That's the least and the minimal that gold can be calculated. On an 001, every dollar is kind of like 10 pips for a currency pair. So an 001, every dollar is gonna be a dollar. If you look at when I drag this from where the sell limit is, and you kind of pay attention to the price on the right? We go from 27.23 to 27.24. There's a dollar, literally a dollar. So 001, so it multiplies when you go to 002, 003. You have another dollar. So from 27.23 to 27.25, that's $2. Notice I would be down $2. So on gold, we got to look at every dollar value. How much can every dollar be worth, or every $5, every couple dollars, right? It's important to understand this when we get into lot sizing, guys. But MetaTrader 5 makes it easy to see like the value of everything. Even if you're doing a buy limit on gold, maybe you want to buy gold when it comes all the way down here, right? And you put your stop loss down here. It would be the same thing. Like there's $10. So right here would be $10. That's from 26.96 to 26.86. That's a $10 distance on an 001. $10, every dollar is a dollar. So you got to think of these things before you really start getting into trading with bigger money or going high risk, right? Or putting a lot of money into the markets. Adapt the understanding of measuring money in the market too. All right, guys, I'm going to see you guys on the next video. These are things you need to understand, especially for the live sessions or when you're taking signals with us in the market. See you guys on the next topic.
When I first started trading, I would literally put 5-10 hours a day into the charts, studying the markets. People ask me how much time a day do I put into the charts now. I still put 5 hours a day into the markets. I still put 10 hours a day some days into the markets. Why? Because now I'm able to do more in 5 hours than I was then, right? You don't want to really be fooled by the calendar. There's as much days in the year as you make worth it. And when you keep doing something consistently for such a long period of time, you get better at it. And your months turn into years. Your days turn into weeks. Your weeks turn into months. What I mean by that is I'm able to do in 1 week a lot more than I was able to do 10 years ago, 5 years ago in 1 week, or in 1 month even. I can do in 1 week right now, maybe what I used to be able to do in 1 month. I can do in a couple of months now what I used to be able to do in a year. So if you're a new trader, and even if you're an experienced trader, because a lot of you experienced traders don't think you need to put in the time. A lot of you experienced traders are looking for shortcuts. You're looking for the quick way around it, and you're not putting that time in. You're spending more time on hobbies, on things that waste your time, right? I started trading, I would put 5 hours a day into the craft, the skill set, because I understood that was the cost and the sacrifice to get me ahead, right? Now, I still put that same amount of time, but I'm able to do more in that amount of time. I'm more effective, I'm more efficient, I get more done quicker, right? I make more money in that same amount of time, right? When I first started trading, I was working a job. I was 17 years old, and you guys are gonna hear me talk a lot about my story on this session. If you guys have any questions, you guys have me in. If you guys have any questions, you guys have my contact. You guys can message me if you guys have any questions, or ask me on the live sessions, Q&A sessions, right? When I first started trading, I was young. I was only making like $1,500 a month, but I was still putting the time in. I couldn't put a lot into an account. I would put $100 in an account, and I would try to flip it to $500. I would put $200 in an account, and I would try to flip it to $1,000. Or I would try to go from 200 to 500. I would try to just increase my capital. I got good at doing that, but I went within my means, right? I wasn't making a lot of money, so I could only put like $100, $200, $500. But as I got better at going from 100 to 200, I gained confidence. I went from 100 to 200. That made me gain confidence. I did that in a week, or I did that in a day, did that in a month, gained confidence overall. That's what this academy is going to help you guys build, especially if you're already an experienced trader. If you're a new trader, you're starting on the right path, the better path for trading. And I'm gonna go over 10 key points for a trading plan here in this video, guys, especially for beginners. Maybe some of you guys watching this are gonna have to take a step back. Maybe some of you guys have been trading for a year, 2 years, 3 years. You're like, oh, well, maybe I need to take a step back and broaden my horizon and set clear goals for myself, right? So number one is define your financial objectives and set realistic goals for your trading plan. This will help you maintain focus and measure your progress over time. If you just started trading, you're not trying to sit here and make 100K your first month. It could happen, anything can happen in the markets. I've seen a lot from beginners that have progressed literally in 3, 4, 5, 6 months. They somehow flip an account with the knowledge and it's like, whoa, how did you do that? I've seen people do a lot, but you don't want to be like expecting I'm gonna make 100K my first month. Start small, because remember what I said at the beginning of this video. When I first started trading, I was 17, 18 years old, had bills to pay, right? So I couldn't just put all my money in an account. I was making $1,500 a month. So I had to start small, but I understood the bigger picture. I understood if I was good at going from 100 to 200, one day I'll be good at going from 1,000 to 2,000 or 1,000 to 5,000, right? Because if I can go from 100 to 500, I can take 1,000 to 5,000, right? Or I can take 5,000 to 10,000 or 10 to 20, right? I understood that in the beginning. So I understood right now, I might not get where I want to, but what about 2, 3 years from now? What about 3, 5 years from now? So that's why I say set clear goals for yourself. Don't try to take the shortcut around things and get to the 6-figure trader your first year. It can happen without trying, right? You don't want to try to make money. You want to follow a plan. You want to create a plan, follow a plan. The goal is to make money, yes, but we have to kind of reverse engineer the way that we think about money and how we approach money. You're going to learn throughout these types of lessons, these mindset lessons, that money is an emotional topic, and most people don't know how to handle money, and most people don't know how to handle their emotions when it comes to money. Most arguments, I'll be honest with you guys, most arguments in my family or in anything in life usually come around money or have come around money. It's an emotional subject, right? So we don't want to lose it. We fear to lose it, but we're greedy. We want more. And we're going to talk more about that in other videos like this. Number 2, define your time horizon, right? Decide if you want to make money and trade short-term, intraday swing, or long-term, right? Determine your style. That might take a couple of months to really get used to be like, okay, I'm more of a quicker guy, in and out. I don't like holding trades long. I want to get out with quick profit. You know, I like just catching a quick move, 5, 15 minutes, 30-minute trade, hour trade, 2-hour trade. You have to define that. Some people are maybe a little bit more laid back, more conservative, and they hold trades for weeks at a time or days at a time. You really got to define your style of trading, because you can set your goals a lot more clearly with that being said. And you guys are going to learn a lot more about all these topics in the live sessions. Like the live sessions, guys, are going to be where I give you guys so much knowledge, because a lot of this is just at the top of my dome. I've been doing this for 10 years, right? So there's so much I can go over in these videos for you guys. I'm going to add videos to the Academy every month. All the videos that you guys are seeing first in this first series aren't going to be all the videos. I'm going to add videos on a lot of these topics too. So number 3, establish clear entry and exit rules. These are some tips to building your trading plan, right? Things that people don't really think about in the beginning. People don't really define a specific criteria for entering trades. Example, technical indicators, price patterns, a candlestick closing. These are things I'm going to teach you guys throughout these trading plan videos, because we're going to have more videos on this topic. And as you see our blueprint and our kind of cheat sheet guide to creating a trading plan and our other videos, you'll understand a lot more visually. These are just the tips and things that I would study. You can build on these topics, right? Go on the internet, ask the internet questions about these topics as well. Look up quotes, see what other traders say in the world about this, because these are the things that I understood are key to building a trading plan. Risk management. Determine how much you're willing to lose on each trade and set acceptable loss limits. So your losses, you got to look at them kind of like a cost of operation in the business, because the business is long term. Let's say you owned a store. You had a physical store that you owned. Maybe you owned a pizza store, for instance, right? There would be a cost of owning that pizza store. There would be cost of equipment, utility, and everyday function to own that store, right? A cost of operation for a business. So how you want to think of your trading account, and how most traders don't think, is my trading account is my business, right? My trading account is my business. It's not a hobby. It's a business that I want to grow. But there could be a cost of operation to grow this business. I have to find that. I have to find that limit that I'm willing to. I don't want to go too high, but I want to make it meaningful enough that the cost of operation can profit me something meaningful. I don't want to go too small, and I don't want to go too big. I want to go in the middle. Most traders go too small. Most traders go too big. You want to find a balance of closer to bigger than smaller, in the middle range. This is really important. I'm going to talk a lot about why in a lot of our live sessions in risk management. Determine how much you're willing to lose. Accept it ahead of time. If you're going to take 100 trades in the year, right? How much are you going to risk on every trade? Is it $5 per trade? Is it $10 per trade? Or let's take a step back, for instance. If you're going to take 2 trades per week, for example, is it going to be $10 per trade? Because if I'm taking 2 trades per week and I'm risking $10 per trade, my max risk for the week would be $20. This is how I think before the week starts, before the day starts, when I fund my trading account for the week. I already think if I put 5K in my account, I already know what the first trade risk is going to be. It's going to be $800, $700, $500 on the minimal range. Between there, that's my first trade that I'm risking, me personally, right? So I already know my plan ahead of time and the risks that I'm willing to accept ahead of time. Now that might seem like a lot for the account balance, but that's me, my personal risk. Let's say if I have a $100 account, for instance, and I'm going in the week, and I'm going to risk $5 on one trade. If I lose the trade, I know I'm going to be at $95. So you have to look at if that is going to hurt you. Is if I have a $100 account and I take a $5 trade and I lose, is that going to affect me financially? Because if you treat it like that, you might get more emotional. You don't want to be an emotional trader. You want to think of the long-term game consistently. So that's why risk management is going to be key inside of your trading plan, but determining the cost of operation, right? Diversify your investments. This really comes down to if you're like more of a crypto portfolio holder, right? It's not good to be all in one crypto. The main crypto I would be all in if you're going to be in one is Bitcoin. And then it's good to, after Bitcoin, have a couple other coins like Ethereum, Solana, and then like a high roller coin, like an alternative coin or a meme coin. You kind of want to spread things out, diversify in that sense. Have a max holdings of like, I'm only gonna have 3 holdings. For me, for instance, for me right now, I like to have Bitcoin, Ethereum, Solana, and then I have a coin called WIF right now that I have a big holding of. That's like my high roller coin. That's like my higher risk coin, but it's a little diversified from my big 3 or my main one like Bitcoin, right? A little bit of diversification in there. It's good to diversify and think of those things when it comes to like portfolio holding. We could talk more about that in the session. Here's number 6. Number 6 is something that most traders don't do in the beginning. They might learn it later on, and me too. I can talk from number 6 from experience. I didn't start journaling until like 4 years into trading, 5 years into trading. I didn't think it was important. And I realized it is important because you're gonna forget about a lot of situations in the market. Because if you're trading for a year and you're trading for another year, you're not gonna remember every day as efficiently. So it's good to record all your trades, including entry and exits and details, the reason behind each trade, and your emotions during the process. This will help you analyze your decisions and learn from your mistakes more. Because let's say if you don't journal and you have really good trading experiences, like setups that you're really winning, you can always go back and look at what the winning setups were like and get a picture of what you should be looking for moving forward. Let's say you had a great 4 months trading and every setup you took, you followed your plan and the setups were great. You want to journal that and keep a picture of it for the future and remember those experiences. And journaling is something we want to review. Most traders don't do this, and you're going to see me talk about it in other videos as well. Test your strategy on a demo account. Before risking real money, guys, it's good to test your trading plan. Test and practice on a demo account or even a small live account. This will allow you to familiarize yourself with the trading platform and eventually the effectiveness of your strategy without taking financial risk. If you're a new trader, this really applies to you, or even if you're trying to practice a new strategy, it wouldn't hurt opening a demo account, testing it for a month, and seeing how you perform. But the demo account, you want to treat it like a live account. You don't want to go on your demo account, go on your phone and just click trades, click trades, click trades, click trades. In the beginning, you can do that to get an idea, but once you start really trading and following a plan and a strategy, you don't just want to go on your demo account and aimlessly trade. That's a bad habit that a lot of traders get into. They won't trade their live account. They may just go on a demo, trade random pairs and just put random trades just to feel like they're trading. So it's a bad habit that a lot of traders get into. I recommend demo or live. People always ask me, if you're a beginner and you're just learning how to trade, that you've never traded before, demo account for the first couple of weeks, demo account for the first 30 days. That's what everyone does. You got to get a feel of the lot sizes, how the money moves, how the pips work, how we can measure money in the market and understand risk more. So it's good to just, if you're a new trader, demo account in the beginning for sure. It's gonna help you out a lot to just get the practice and feel of the charts. Because if trading something completely new to you and you've never done it before, it's kind of like riding a bike, right? For the first time, or learning how to ride a bike, you gotta get on and you might fall off a couple times. You might make some mistakes, which are good. You make a mistake and you're like, okay, I know what not to do now. Don't let a mistake result as like, I'm a failure. Don't tie a mistake to, I'm a failure, I can't do this, this is hard. Look at the mistake and realize it, analyze it, acknowledge it, and be like, okay, I'm not gonna do this again. That's what successful traders have done to get to where they're at. Successful traders aren't successful because they learned a strategy and it worked for them. They stood the test of time, right? They managed to overcome their failures and their mistakes in the market. That's why I'm starting with one of these videos when it comes into mindset and trading plan as well. Learn constantly, guys. Learn constantly. I talked about in the beginning of this why I still spend 5-10 hours a day on charts, because I'm constantly learning. I'm keeping up with the market. I'm sharpening my sword still. You want to do that. You want to learn how to compound your time. Most people, I look around and I go out every day and I talk to average people. Average to me is just a mindset, okay? But a lot of people have an average mindset. They don't think like me. I'm around a lot of people every day and I realize I think differently than a lot of people. So what do I think about in terms of time? You guys can ask me a lot of questions on time, and there's different ways I think about time. But I think about compounding my time. I understand if there's 7 days in the week, and in those 7 days, I do 5 hours a day of watching videos, watching the candlesticks, maybe practicing taking some trades. There's 7 days a week, and I understand if I'm gonna do 5 hours a day, that's 35 hours a week. Now, we have on average about 4 or 5 weeks a month, right? If I'm doing 4 weeks in the month, it's 140 hours a month I can get out of putting into the skill. The progress is key. If you go to the gym, someone who goes to the gym 2 times a week or 1 time a week is gonna look in a lot better shape than someone who goes to the gym 5 times a week, right? Or someone who spends 2 hours a day in the gym is gonna look a lot different than someone who goes to the gym for 20 minutes, right? A lot different, right? So you gotta think about time, consistency, repetition. You gotta think about compounding your time. You might be like, Evan, I don't have 10 hours a day to look at the charts like you do, 8 hours, 7 hours a day, it's okay. You gotta think about compounding your time, right? What if you only have 3 hours a day, right? 3 times 7, 21 hours a week, times 4, that's still 84 hours a month you're gonna put into your new work, right? Your new job, right? That time you need to build up, because if you multiply that by the months, that's over 1,000 hours a year. It takes 10,000 hours to master something, right? That would take you 10 years then at that rate. If you do 8 hours a day, it's gonna cut the time down in pretty much like a half, right? To get there. It could take you 4 or 5 years to master the skill set, 3 years to master the skill set, where after 5 years of doing something, you make more money in that 5th year than you did the entire 5 years. If you do something for 5 years, right, you can make more money in that 5th year than the entire 5 years. This is why you want to constantly learn and find different ways to improve your skills and learn from your mistakes. Study different approaches of technical analysis. Be like a sponge. Be open-minded, but always keep learning, guys. Find the best in everything, right? Look at your results and try to find the progress and try to find the good in everything. Even if you blew an account, let's say you took the account from 500 to 2,000 and then you blew it. You did something right, but you did something wrong as well. Learn from the wrong, find what you did in the right. Control your emotions. We're going to talk about this in a lot of other videos. But what you got to understand from this is that trading can generate intense emotions, such as fear and greed. You want to learn to maintain and have a disciplined mindset and make decisions based on your plan, instead of getting carried away by the emotions of the moment and the market. Be patient and realistic, guys. Successful trading takes time and requires patience. Don't expect immediate profits overnight, or don't be discouraged by temporary losses. Keep a realistic perspective and continue working on your long-term trading plan. And remember, trading involves risks, so do a lot of research as well on the topic as well. The internet is huge. I'm going to help you guys understand how I became successful. This is not financial advice. This is education for you guys to take and grasp so you can get from point A to point B in life. Because trading is a huge vehicle that can help you make more of the money that you already have. It's not about how much you make, it's about how much you can keep, guys. So I'll see you guys in the next mindset videos. We're going to be talking about more about controlling your emotions and being patient in some of our next mindset and introduction to psychology videos. I will see you guys there. Welcome to the introduction to trading psychology. This is a big topic because in trading you have technical analysis, fundamental analysis, and then you have mental analysis. So this chapter is crucial. It's going to be a big step in your Forex trading journey, because developing a winning mindset and a winning Forex trading psychology is essential for making consistent profits in the market. Understanding the reasons behind your actions is key to becoming successful in this game. So there's an importance to trading psychology. To succeed in the markets, you need more than just technical skills and general market knowledge. A deep understanding of market fundamentals and technical indicators, risk management, trends, patterns, all that stuff is super necessary. It's a big however, with even all of these skills, being able to read the chart patterns and trend recognition, risk management, all those things that I just said, even with all these skills, a poor trading psychology, a poor trading mindset, an undisciplined trader, an impatient trader, an emotional trader, right? These are some of the emotions, such as fear, greed, anger, right? These can cloud our judgment and make us lead to poor decision making in the markets. So many traders who are intelligent and knowledgeable about the markets still find themselves losing repetitively in the markets. The reason is simple. They let their emotions dictate their actions more than just a practical way of thinking with their strategy. So this chapter is dedicated to understanding psychology more, because like I said, to be a successful trader, it's critical to learn how to control your emotions. Controlling your emotions doesn't mean avoiding them. It means managing them effectively in the market. When trading, you'll experience strong emotions, especially when making or losing money. This is natural and essential part of being human. We're all human, and these are emotions that we feel. A comprehensive trading plan can help manage these emotions by promoting consistency and discipline. Losing trades are not the end of the world, but part of doing business. So when you have a plan, each trade, whether it's a win or a loss, it just fits into the bigger picture of your trading strategy and your plan overall. So what is trading psychology? What is this in the market? These are emotions, feelings, and the thought process to making rational decisions in the market. Successful traders, disciplined traders, they stay more rational and they don't yield these feelings like greed and fear. Fear, for instance, can lead to decision paralysis. It can make you unconfident. Scared is what that means, to make a decision, and really take you away from your trading strategies and make you miss out on the real opportunities. And then that can lead to a whole nother cycle. Anger often results from frustration and can skew decision making. Anger usually comes from something that was unnecessary, breaking the rules, not following the plan. Impatience leads to over trading and inconsistent actions like revenge trading or over trading. Greed also encourages these types of things, especially poor money management decisions. So fear is number one. Fear is a major performance detractor in trading. It typically arises after a series of losing trades, or if you blow an account or you have a bad situation that shouldn't have happened, causing traders now to kind of like hesitate and really miss out on opportunities in the market. Fear can lead to passive trading and kind of straying away and being really on it and confident, having that rhythm and flow with the charts. Overcoming fear involves implementing strict risk management protocols and gaining experience in the markets. Trader must recognize, like I've said before, losses are a part of the game. So you got to recognize that early on in your trading, because scared money don't make no money. I'll tell you that much. Anger. Now, anger is another thing that we can experience in the market. See where it says revenge trading, gambling, ego, anger. Anger is all of this, right? Anger in trading often stems from frustration and perceived inability to grow one's trading account. When angry, a trader's perspective is skewed, decision making is pretty impaired, and overall trading psychology is compromised. Most of the time, anger results from poor risk management and rapid financial losses. Managing anger involves taking breaks from the market and reducing the leverage and maybe trading smaller. If you go through some of these feelings, some of these emotions, it's good to take a step back, right? Review what went wrong. What did you do wrong? Especially if you're in this business for the long term. There's times where you may need to take a step back. If you went on a big losing streak, if you had an unnecessary loss that shouldn't have happened, right? Take a step back, analyze what got me into this situation. How could I perform better next time, not get in this situation again? Because remember, it's all about the long-term growth. Remember, risk to reward, what we talked about with that, right? That can keep us consistent long-term. Impatience. Impatience can really just wreak havoc on a trader's account. It often leads to over trading or just entering too early, then missing the real trade, missing the setup after, which still leads to over trading. So over trading, guys, is the act of placing too many trades in a short period of time. You're trading in New York session, you get in a buy, and then you get out, and then you get in a sell, and then you get another buy. Like, you're over trading the market in too short period of the time. And over trading can deplete your capital quickly, especially if you don't recognize it. It's a sign of the lack of discipline that a trader has. Professional traders are characterized by their ability to act consistently in the market, sticking to their trading plan. The only way you're gonna act consistently over time, because in trading, slow is fast, is if you're not impatient, right? Is if you're a patient trader. That's the only way you'll be consistent, because you need more time in the markets. There's not gonna be a setup every day. Now, let's talk about another emotion that you may experience: greed. The reason I'm making these videos is so you guys are mentally prepared, right? You know, it sucks in general life when something happens to you and you didn't really know about it, but you could have been aware of it before. Someone could have told you, right? Like, hey, you're gonna go through this if you do this, or the likelihood of this happening, or this is things you're gonna go through, right? I didn't know all this when I first started trading. I had to learn it through my own experience, right? And that's why I am where I am today, because I've stood the test of time. If you really want to learn more about this type of stuff on mental analysis, because remember, we got technical, fundamental, mental analysis, trading in the zone, or listen to Mark Douglas. I've talked about him in some other videos. Greed is a double-edged sword. Let me talk about why. While it can drive the entrepreneurial spirit, it can also lead to excessive risk-taking or too much risk-taking, right? And poor money management at the end of the day. It may not always follow the longer-term plan. In Forex trading, greed often manifests itself as the desire for quick or larger profits, leading to over-leveraging and ignoring the longer-term trading plan. So in trading psychology, a solid trading psychology involves recognizing the dangers of greed and trying maybe not to get yourself into that mix of greed, right? How can you get greedy? Let me explain. If you're trading too small and you win 10 trades in a row, you'll probably get greedy because you'll look at the lot, you'll look at the wins like, damn, I just took 10 trades in a row and I didn't win I made 20 bucks. You might not be satisfied. So greed comes from displeasure or not being satisfied, right? So greed comes from not being satisfied, right? You get more greedy if you're not satisfied with what you have. You lose the value of something, right? You want more, right? Out of life, you want more. So that's what greed comes from. You could be doing good and still be greedy, right? Because you can make a little bit of money and that might cause you to be more greedy in the market, right? Greed doesn't come necessarily when you're making a lot of money. It might come when you're making a little bit amount of money because you want to make more, right? So that's the thing that comes down to greed. You have to reverse engineer the way you think it. That's what I realized is greed doesn't always come when you're making so much money. It can when you're on a big win streak too. When you're winning a lot of trades, you're winning a lot of trades. So it can put you in a position to benefit you at times. I've had times where I've been super greedy and like risky, and those have been some of my biggest profit times. But then those are also the days where I've been like, wow, I should have just done nothing, right? And usually it's a double-edged sword, but I would say from my experience, it's more on the one-sided of no, it's not good in the end. In the longer run, there's going to be times of greed that do pay out, that do benefit you, but you have to understand that it's not always a good emotion to have. You really would just want to achieve the Forex Zen, right? The master Zen in Forex. You want to be like a robot. You kind of want to be like this guy. This guy's tough. He's Zen. He's pretty much like a robot, right? He doesn't move. He has no emotions. He has a positive trading psychology. He has self-discipline. He has a strategy, and he has risk management. You want to be on top of your game. So how do you achieve this, right? Achieving a balanced trading psychology, often referred to as the Forex Zen, involves accepting that risk is an inherent part of trading. It's a familiar thing I'm trying to install into you guys a lot. Understanding that not all trades will be winners is crucial. Even when following your rules, even when following your plan, you will still have losses that come and occur. That is normal. These should be seen as business expenses rather than failures. A real loss happens when a trader ignores their strategy or ignores their plan or follows external tips or based on something like emotions, right? So successful trading mindset recognizes that a winning trade and losing trades, two sides of the same coin basically. So a successful trading mindset recognizes that a winning trade and a losing trade are two sides of the same coin. I win a trade, move on, follow the plan. I lose a trade, move on, follow the plan. Review everything at the end of the week and maybe adjust, right? If you make a mistake, review those mistakes, right? So that's what it comes down to creating that Zen. It starts with a trading plan and being disciplined. We have other videos, guys, that go over the Forex trading plan and where to start. This video is not going to go over the trading plan. Other videos will. This video is just introduction on trading psychology. So we're going to talk about how to do all of these other things and other videos. If some of you guys are experienced already, you can take this information, and if you're at the level where you know enough stuff but you haven't done this, you haven't created a detailed plan, a comprehensive trading plan, you haven't really practiced risk management, because tying all these things together is going to make you maintain your emotional discipline. Emotional discipline means sticking to your plan regardless of market conditions. Avoid making those impulsive decisions based on fear and greed. Keep a trading journal, continuous learning, seek support. You guys are in a community here in the groups, right? And all the group chats. So these are some rules and some things you can implement to start your trading psychology, right? Keep a trading journal, continuous learning, seek support, guys, right? You guys are a part of a community. We have the group chats. You guys are surrounded by people who have been trading for a year, 2 years, some people 3 years, some people even a little bit more, myself 10 years. So ask questions. Ask people questions from what it was like in their beginning. What did they do with this? What did they do with that? Everybody might have different answers that might help shape your perspective about the market. Look what I wrote here. I said take breaks. Why did I say that? Regular breaks from trading can prevent burnout, right? We're on the charts every day. We're using our brain a lot. So taking a break can help you return to the market with a fresh perspective. Use the time to relax and gain your energy back and recharge that mindset into more confidence. Why do I say this? Let's say you have a bad week. People always ask me, what do you do when you have a bad week? Or if you have a bad month, you may take a break, take a step back. That's what I used to do a lot. I don't do it as much anymore because now I'm way better with risk management. But back in the day, if I had a bad week, if I had a bad month or just an experience that shouldn't have happened, I would usually take a break. I would take a step back. I would maybe take a week off, a couple of days off, just to kind of regain that energy and that strength back and that commitment again, regain that confidence, right? Because from my experience, when I first started trading, if I took an unnecessary loss, it would hurt. I would get really upset. I would get sad. I would get angry with myself. It's those experiences that are going to turn you into a better trader. All right, guys, welcome to Trading Psychology. You guys are going to have all these PDFs, all these files. They all have different rules, tips, advice, and just reviews of different disciplines in trading psychology and the mindset. There's different files. This isn't going to be the only one, but I want to give you guys a quick little introduction to trading psychology and help you guys understand that this should be something that is not neglected. Trading psychology is a critical yet often neglected aspect of professional traders. It's going to be one of the things you need in your toolkit. You really need a strong psychology. There's technical analysis, fundamental analysis, and then something we professional traders and disciplined traders like to call mental analysis. So this topic is going to dive more into an introduction to trading psychology. You're going to see similar videos like this one, guys, in the academy, because honestly, there's just so much we can talk about on this very specific topic when it relates to psychology and emotions in the market. So when it comes down to understanding trading psychology, we're talking about managing emotions. Managing emotions is a crucial aspect of successful trading. Traders often experience a range of emotions such as fear, greed, excitement, overconfidence, nervousness, maybe even anxiety at times or stressed out at certain times, all of which can impact a trader's decision-making process. So here are some key strategies for managing these emotions. If you're a new trader, I want you to understand that you're gonna go through things in the market. I wanna set you guys on the right path because I learned all these things after years and years of trading. I wish I kind of had someone tell me like, yo, this is some of the stuff you can go through, right? There's a lot of emotional intelligence behind this game. You need to learn how to mentally analyze yourself as well and also become more disciplined in your trading. So I want you new traders to understand that and not get scared when we have conversations like this, okay? I want you guys to embrace it and really be open-minded and understand you're building your character through more topics and discussions like this, because once you have your own experience in the markets, once you go 3, 4, 5 weeks, you're gonna come back to these topics and be like, damn, now I can relate to a lot more of what he has been telling me since the beginning. So I'm trying to set you new traders on the right path. I'm trying to help you experienced traders that haven't really gained that edge over the market yet, gain more confidence, maybe refine some things, define what psychology is for you, because maybe your mental approach isn't right. Maybe you're not mentally going to the market appropriately. I've made a lot of money, and the more money I've made, the differently I've thought about money, the differently I've approached money. I've realized everyday average people think about money a lot differently than I do. So the way I approach my risk is a lot different than how average people do, because I don't think how average people think. And when I say average, guys, it's just a mindset, okay? It's just a mindset that we're thinking, right? Most people don't think like me, so that's why I have the results that I have, right? So number one, develop a trading plan. Have a well thought out trading plan that can help produce the impact of emotions in trading decisions. A plan should include entry and exit rules, risk management strategies, and goals. We're gonna talk more about how to create a trading plan and other videos. These are the first 10 things that I want you guys to take into consideration if you're a new trader. And if you're an experienced trader, maybe you need to take a step back and really focus on some of these things and implement some of these things like risk management and stay more disciplined, right? Follow your trading strategy, right? When I lose a trade, I don't really care if I lost 10,000, 20,000, 5,000 on a trade if I was following my plan, but I really get upset with myself. I really get angry. I really get emotional if I lose $5,000, $10,000 on a trade and I didn't follow my plan and I broke my rules. That is when I get pissed off at myself the most and I have a bad day. Then my normal regular life turns into a bad day. Let's just say a crappy day, right? So you want to stay disciplined and follow rules. But the first step is maybe setting some rules for yourself, right? How many trades a day am I going to take maximum, right? This is going to help keep our emotions in check if we're able to set some rules and guidelines, because we kind of want to be like a robot in trading, or something I call rhino skin, right? Something I'll call rhino skin is like I could lose $10,000 in a day and just not care. Be like, okay, it's fine, right? Unless I was breaking my rules, breaking my plan, right? Because I'm prepared to lose in the market. I accept the risk ahead of time, but my trading plan has rules and criteria that I know if I follow, I'll be profitable long term. I can't be breaking those rules because those rules are in check, so I can make decisions that take away the emotions, to keep my emotions out of the market. I want to recognize if my emotions are more influencing my trading right now in the moment, or if I'm following my plan, right? Consider implementing things that can make you take a step back from the market and help manage your emotions. Learn from your mistakes. We're going to talk about this a lot. All of these, we're going to talk about a lot in this academy. Learn from your mistakes. Instead of dwelling on losses, use them as a learning opportunity. Analyze what went wrong and how you can improve your strategy for future trades. Most traders look at mistakes or losses or losing streaks or a blown account as I'm done, I'm a failure. They tie that to a more of an emotional thing. They think more emotional with this. Let me tell you a story, guys. When I first started trading, it was me and one of my high school best friends that I started trading with. I knew this guy my whole entire life. We both started trading together. We both started an account with around the same amount of money. It was around about $500 each. We both were trading our first month trading. In our first month, we both blew our entire account. He quit and said, I'm not gonna do this anymore. This isn't for me. The emotional impact of the loss, the financial loss, the emotional impact, and then the fear afterwards, because now it's like, whoa, I'm a failure. This is hard. I just blew my account. I don't want to lose any more money doing this. I don't want that to happen again. The fear of that, right? Me, I thought differently. My friend, he quit, never has touched trading in his life since that month. That was in 2017, September. He has never been trading since. That was it. That was it for him. Me, I looked at it differently. I had a different mindset because I was doing personal development. I was reading books. Me, I was more disciplined at the time because I was doing personal development. And I understood from personal development, a lot of successful people talk about, you got to learn from your mistakes. You got to learn from your mistakes. You're going to learn from your failures. They will happen in the beginning, but you learn from them. So I had a different way of thinking than he did. I said, okay, how can I overcome this? How can I not do that again? Because I know this is something that makes people money. I want to be like the 1, 2, 3%. I don't want to be like the 97% in the world, right? So I had a different mindset and approach to my mistake at the time, and it was early on in my trading. I said, how can I overcome this? How can I learn from this mistake? Because I saw progress inside of that, even though it was so bad, even though the end result at the end of the month was a blown account. Throughout that month, I was learning, I was educating myself, and I was understanding the markets more. And I was taking trades. I was making profit in that time period. So I was seeing results. I was seeing progress. I was seeing the good in something bad. I was learning from my mistakes, right? I was seeing the bigger picture. I was like, if I keep doing this consistently and I make a plan and I learn from my mistakes, I'll figure it out one day. Next time, let's take a step back. So what did I do? I would take a step back. Anytime I had a situation like that, I would take a step back and focus on the process, guys. I'd focus on the process. This is a part of the process, right? I wouldn't relate this current outcome to this is the result, right? I would realize that there's gonna be a better time later if I keep doing this for 2-3 years. Now I look back at those days and I kind of laugh. I kind of laugh at those days because I'm like, man, it's kind of funny where it's like, man, I would lose $500 and freak out. But now I laugh at those days because even though at the time it was an emotional experience, now it's something I can look back and be like, wow, I needed that. I needed to overcome that so I could overcome fear, right? And overcome something called FOMO, the fear of missing out. This is something you have to understand. Any type of trader you are, investor, portfolio trader, crypto, you really need to understand this in crypto too, right? Gold, any market, right? FOMO, or the fear of missing out, is a common emotion among traders that can lead to impulsive and irrational decision making. It often arises when a trader sees significant price moves in an asset and feel pressured to enter a trade to avoid missing out on the market moving even more. To manage FOMO, traders should first recognize when they are experiencing this emotion. You want to acknowledge your mistakes, like I just said. You want to acknowledge your emotions, right? Most people don't acknowledge things. They blame it on other people. They blame it on people they're following. They maybe blame it on the markets. They say, oh, the markets did something random. It's the market's fault, right? They blame it on maybe their strategy, right? So a lot of people blame things and they don't blame themselves and they don't acknowledge these emotions. Signs of FOMO include feeling anxious, like looking at the trade all the time. I got to see the trade. I got to keep looking at the trade, right? Or restless about missing out on a trade, like I keep looking at the trade. I can't sleep, or these types of feelings, right? Constantly checking price movements, right? Like I was just saying, I have that written there. Or maybe just making rush decisions, like you're just entering a market without really doing much analysis or taking your time or following your plan, right? So once FOMO is identified, you can take really steps to suppress this. One approach is to remind yourself that there's always a new day, a new week, a new opportunity. So it's important to trade with a clear mind and only with capital that can be comfortably risked. FOMO is really a stage where you're going through anxiousness and these certain emotions, and you might risk more capital than you want to, or the opportunity might not be a comfortable scenario where the market has give you an edge where you should enter. Let me give you an example. Let's say you're looking for buys on gold and you're looking at price, you're not in buys yet, but you're looking for buys. You think price is gonna go up. Your analysis shows you that price is gonna go up for gold buys, right? You don't check the charts, 20 minutes go by and you look at price and it's shot up and you're like, oh my gosh, the buys, I gotta get in. And you think price can keep going up. This might be a place where FOMO can be recognized. Or let's say you're looking for gold sells and you're just chilling and then all of a sudden the chart moves and you're not in sells. It moves a lot. Maybe an hour goes by and you check up on the charts and you're like, oh my gosh, price has dropped. That's maybe where FOMO can be recognized of like, did I miss my entry? You maybe have to take a step back and see if the opportunity was really missed already, right? This is the FOMO cycle when it comes to greed, excitement, fear, and anxiety, right? Most of the time, right, you're buying when price moves. If you see a big green candle, that might induce you to go into the market, right? You don't want to do that. You don't want to be buying after something has moved significantly, right? This is a time where you might be trading more off of emotion based, and that can catch you entering at a higher point than you originally wanted to, or than you originally should have. You have to view the market in these stages when it's moved and be like, should I have already been in price? If that's a question that you check off, yeah, it's moved 50 pips already. Yeah, it's moved already 100 pips. Yeah, it's had like a 30, 40 pip movement. I should already be in this. Does that check out? Yeah, okay. That's FOMO right there. That right there, if you don't get past, if you go above that, you're gonna enter a FOMO cycle potentially. And that's where you might be buying higher, close your trades, you miss the sell, and it's just a cycle that really repeats, especially a lot in crypto. So here are some common mistakes that traders make, especially in the beginning, because remember, trading is a long-term game, and most traders don't last really even 3 to 4 months, guys, 4 to 6 months, or even up to a year. Most people quit. Remember the story I was telling you about my friend? He literally quit in his first month. I've seen a lot of people quit in the first 3-4 months. Most of the people I went to high school with, and most of my friends, and most of the people that I knew early on in trading, they all quit in literally like 3-4 months of trading, not even a year, because it was just too time consuming for them, too much energy. They didn't have the right dedication. They didn't see the bigger picture. Understand this, once you get good at trading, you can do more in a couple of years than most people will do in a lifetime. I can do now in 1 month more than I used to be able to do in 1 year working a 9 to 5. I used to make $20,000 to $30,000 a year working a 9 to 5, 50 hours to 60 hours a week. I can make that in 1 month in the markets now. So that's the perspective I want you guys to have right now. Longer term you, 5-year trader you, 10-year trader you, 3-year trader you, right? The longer term version of yourself, right? The trader you are now is not the trader you're gonna be a year, 2, 3 years from now. There's always these new beginnings. These are the common mistakes you want to avoid in the beginning, especially if you're a new trader. And hey, some of you guys that might be 6 months, a year, some of you guys watching this might be even a couple years in and make these mistakes and you ignore them. You might be ignoring your mistakes and not really even focusing on what am I doing wrong? Why am I losing? So maybe over trading, inconsistent position sizing, over leveraging, ignoring stop losses. These are some things that you might be doing. Or if you're a new trader, these are things you want to avoid in the beginning. You don't want to be too aggressive and too risky in the beginning. Over trading is trading too frequently or too many markets at once, looking at too many pairs at once. Like you're trading gold, USD CAD, GBP USD all at once. It's better to just trade gold if you're just going to trade gold, right? Or it's better to just focus on a currency pair at one time if you're just going to focus on the currency pairs. Crypto, if you're just going to trade crypto, just focus on crypto at the time, right? Too many trades in one session, right? That's what over trading really means, and that can lead to more emotions. When you do these things, you get more emotional. You might get angry at yourself, you might get sad, depressed, you might get stressed out. So these things, doing these, like not having a stop loss, you don't look at your trade, all of a sudden there's a news event and you're not aware of it. Oh my gosh, you might have just blown half your account. It's little things that if you ignore, the market will show you why you shouldn't ignore them. So these are some of the mistakes you don't want to make in the beginning. 5, 6, and 7, chasing the market. So kind of like we talked about FOMO. Trying to enter a trade after significant price movement has already occurred can lead to buying high and selling low. You might be getting literally pulled back on and then the buy comes in. So after the market's like significantly moved, if you still think it's gonna go up, wait for the pullback. Wait. 50% of trading is waiting for a setup and sitting on your hands. Lack of discipline. So this is more emotional decision making, such as trading based on fear and FOMO. Why do you need to get better at discipline? I think just personal development in general. You need to personally develop yourself. Trading's gonna do that already, but I think just read books every day. Exercise your brain, do brain exercising activities to get you better at your more emotional intelligence side, right? Because that will lead to more impulsive trades or poor decision making if you're not as disciplined. It might be taking a trade randomly just because you want to be in the market, right? And it just doesn't follow your plan. The plan is long term, remember that? And in trading, slow is fast, right? Slow pace is fast because you're going for the longer term gains. Failure to adapt. So this is kind of with always stay learning, keep yourself learning, keep yourself educated. Always be willing to educate yourself, consistently educate yourself, and be willing to adapt your trading strategy as maybe market conditions change. What I mean by that is what works this month might not work next month, in the sense of this month might be an uptrend, next month might be a downtrend, right? So the market can change in its cycles and you have to adapt to the market. So one of the things we're going to be talking about is overcoming greed. One of the way to overcome greed is set realistic profit expectations in the beginning. Don't come into trading like I'm going to flip 500 to a million or 500 to 10,000 or 500 to 100K or 500 to this. Set realistic expectations in the beginning. Analyze what am I going to risk on my trades. Am I going to risk $5 per trade, $10 per trade, 20? These are things we're going to talk about more and more in the videos before you start thinking about account flips, right? Going from 1,000 to 2,000 or 500 to 1,000. Start really setting realistic goals for yourself on the lower end. It's like going to a gym. If you've never worked out for the first time and you try go lifting 200 pounds, it's going to be hard to do it. You're probably not going to be able to do it, or it might be hard. You might struggle, right? So you got to start on some lower weight. Work your way up to the bigger account flips, to the bigger risk, to the bigger trades, right? Another strategy to really overcome greed is to focus on the process rather than the outcome. Instead of observing how much money you can make from a trade, just keep focusing on your plan. Instead of looking at how much money you didn't make, how much money you're trying to make, just follow a plan. Instead of saying, oh, I only made $20 on this trade, I could have made more. No, did I follow my plan? Yes or no? If you didn't follow your plan, then it's like, that's probably why you didn't make as much money. If you didn't follow your plan, it's probably why you got stopped out or took a bad trade. If you followed your plan up to execution, that's why you made money or you hit your full profit, right? So following your plan is the point of executing your strategy effectively. This can shift your mindset away from the money, because following a plan will follow the money. Because if you follow a plan, the money will follow that plan after. And following a plan takes away the emotion, right? Money is an emotional topic. Greed, for instance, is something that us humans lack when it comes to money. We want more money, obviously. We want more greed. So if we only make a little bit of money, we might get greedy. If you only make $50 this week, you might look at the trades you took and be like, oh, I could have made more. I could have made more. Next trade, I got to go all in. That's greed right there. That's not following the plan, right? You had good trades, just job was done. Do the same thing next week. Stay within that margin that you did this week. Don't try to do more. If you made $50 this week, okay, next week maybe try to do another 50 or 60, 70. So you build up that profit. Don't look at, I only made 50 bucks this week. I could have did way more. What if I held this trade until here? I could have made $300-400 bucks. Oh man, I got to go all in next trade, flip the account to 500. No, if you made 50 bucks this week, next week, try to make another 50. Try to make maybe a little bit more than 50, or try to use that 50 you made down this week to risk next week in profit, right? So lastly is, with that being said, guys, you guys are in a good community, right? You can ask questions. You can ask other traders questions. There's traders in this, but self-awareness is key in these moments. Being aware of all these things, guys. It's not about how much money you make. It's about how much you keep. Don't look at the small things as super small things in the beginning. Look at them as steps to the bigger picture. Look at the small trades as steps to the bigger trades later on. A $20 trade now can be a $200 trade later, right? A $50 trade now can be a $500 trade later. A $100 trade can be a $500 trade later, or a $300 trade later. That's what you got to be thinking of. What I'm doing now can get bigger later. You don't want to look at, I only made $20 today. If I just put a bigger lot size, if I just had maybe double the lot or triple the lot size, I would have made 60 bucks instead, or triple the amount of what I made today. That is an emotion to recognize. Take control of a moment like that. You have to be like, whoa. This is greed. No, stick to the plan. Back it up. Slap yourself in the face. Maybe splash some water. So this is a quote that I really, really like. Trade according to your strategy, not your feelings. Do not trade for just the sake of trading. You might get bored sometimes and not see any setups. There's days you're going to take 5 trades. There's weeks you're not even going to see anything in the market. You're gonna be like, whoa, I can't find anything. That's when you're gonna get bored. And when you're bored, you're gonna want to try to make money, because especially when you get good at the strategies, you understand the market, you're gonna understand how to make money. You're gonna be like, dang, when you're bored, you're gonna try making money. So that's what this kind of quote means. Avoid trading merely for the sake of trading. Instead, focus on taking advantage of opportunities in the market that present. Some days you might execute 15 trades, while other times you might not trade for weeks. Your trading frequency should depend on the market conditions. So you can break almost every rule in the game, guys, except those related to risk management. Neglecting risk management can eventually lead to being forced out of the market. That's why I said not too long ago, you want to start small and not neglect all of these things. Remember what this video is about? Mistakes that a lot of traders make in the beginning, and why they don't really make it past what I call the hurdle. The hurdle, right? If you know what a hurdle is, or let's say a plateau, they don't get past that breaking point of, wow, I know what not to do now. I understand the game a lot more. It's because they make all these poor mistakes in the beginning. Even with the best trading strategy, risk management poor risk management can lead to bad outcomes, right? Bad outcomes, I want to prepare you guys for these things that traders go through. If you blow an account, you will overcome that. I've blown hundreds of accounts, right? They've only made me stronger and understand how to risk more appropriately. I've learned from all those lessons, right? A blown account is normal. It happens to everyone, I think. Everyone, I think, at some point blows an account or gets over risky with their trades. They might put $100 in an account and say, I'm going all in on this $100 or $1,000. And yeah, everybody has times like that where they get more risky. You'll recognize those times. I bet they will happen to some of you guys. And that's okay, because that's what you're doing in the market, is putting on risk, right? You're learning how to manage and put on risk effectively, right? And me, I've learned how to do that for myself and find an edge over the market over time. So risk is something you have to understand. So in the beginning, it's better to trade too small than too big. The goal is to find a balance in your trade size. It should be large enough for good profits and to keep you really interested and engaged in the market, but not so large that it affects your objectives and your discipline or puts you at risks for big losses. Everyone has different risk tolerance, so trade with an amount that feels right for you. Number 2 is no position is a position. Understand, often the best place to be sometimes is on the sidelines, out of the market. Sometimes the best move is not to trade at all. It's easy to get caught up in all the excitement of trading or feel like you're not doing your job of making money actively if you're not actively trading, right? So not doing something is doing something. Not participating is participating. If you're bored and you're not trading, let's say you can't find any trades and you're bored, you can't find anything, you feel like you're not doing anything because you're not in the market, that's okay. That's an emotion to recognize, right? Because like it says there, no position is a position. So being out of the market is doing something. Because remember, 50% of the time is waiting, staying out of trades. And then the other 50% of the time is trying to catch the move, right? Getting in the trades, right? 50% of the time you have to stay out of the market and wait for setups to come to you, because good trades find you. A lot of traders don't realize that doing nothing, not participating, is participating in the market, because good trades find you, right? So if you ever feel like, I can't find a trade, there's no trades, I gotta just get in the market, that is you feeling like you're bored and you just want to trade for the sake of trading. Remember what our first quote was, right? Trade according to your strategy, not your feelings. So if you're a no position is a, if you understand no position is a position, you understand when you're bored and you can't find something, guys, that's just that emotion kind of taking over. You just got to understand it's normal to not see opportunities always in the market that fit your strategy, because the strategy is over time. There's some weeks where it might not be there. So great trades often present themselves without much effort, while just staying focused and researching is more crucial. Being patient, keeping up with the charts, following the plan, looking for your confirmations. It's better to trade less than to force trades. Forcing trades can lead to losses, frustrations, and more mistakes and missed opportunities, right? Opportunities tend to come in waves due to volatility cycles. So you might be busy at times and then quiet at times. There might be quiet weeks, there might be quiet days, right? Or you feel like, man, I can't find anything. I'm not doing the job. Maybe I'm not a good trader. Maybe I don't know how to trade, right? Maybe I can't see anything this week. What is wrong with me? I see this guy on Instagram, he's catching this trade. I see this guy on social media, he's catching this trade. Something is wrong with me. You can't compare yourself to anyone on social media. If you want to be a serious trader, I would put away social media for your first 3 to 4 months. Maybe not look at so many people, or focus on just the right people. Not get so glued and comparing yourself to someone who's been trading for 5-10 years, right? So when in doubt, stay out. That's a feeling, right? When you feel doubt, you're like, I don't feel good, maybe, right? This kind of ties into no position is a good position, and good trades find you. It also is about managing your emotions. If you're unsure, you're not feeling confident, it's best to just simply avoid trading. Wait for the better moment. Wait for the next session, wait for the next day. If you're hesitant, if you're hasty due to doubt, it's crucial to just recognize this emotion, right? That can lead to a lack of confidence. Understand that losses are a part of the game. Get used to it. The best winners are good at losing. Just like failure in life and making mistakes in life, it's inevitable, right? Losses are inevitable in trading. It's important to accept this fact. We go over this in risk management and risk to reward videos. While nobody likes to lose, right? In general life, humans don't like to lose, right? That's an uncomfortable feeling to lose. Losing is like, I don't want to lose, right? So we have to be comfortable with that feeling of losses and learn how to accept a loss and not avoid them. The most successful traders experiences many losses throughout their careers. Last ones here are shrink your watch list. What do I mean by shrink your watch list? Maybe don't look at 20 pairs at once. Unless you're more of a swing trader and you're someone who's looking for 1 or 2 trades a week, you can go through a lot of pairs to look for that perfect market structure setup. I have swing trading approach, day trading approach, but it's good to kind of keep things narrow. Maybe not look at 20 things at once if you're trying to day trade the market. Know what you're trading and what you're going to focus on. For instance, I like to just trade gold. Routinely take a step back, and then trading is mostly stressful because we make it because of all these emotions. Routinely take a step back means it's important to avoid going all in all the time. This can lead to something called burnout. Take days off and don't really skip vacations out on the fear of missing out on movements, right? There could be days where you're like, you know what, price has already done its thing. I'm gonna let the market do what it's done. I'll come back tomorrow. I'll come back next week. The markets will always be there. So if you ever feel burnt out, you ever feel like you're just too frustrated, you're exhausted, your brain's just too much, take a step back, go back to the basics, refine a lot of these basics that we talk about in these videos. If you ever feel like you're stressed out, you've been burnt out too much, take some time off trading for a week, even 2 weeks at a most, and watch some of these basic videos. It'll help you refine things back to that energy that you need. It'll help refine things back to that real energy you need and that rhythm that you need as a trader. So these rules and outlines and guides are for you guys. You guys have this PDF, right? You guys have all the trading psychology PDFs and mindset PDFs. These are all mistakes, things to avoid. Review them every week and review them every month. A lot of these will synchronize with you, especially when you start trading more. Maybe in the beginning, you're like, none of these relate to me because you just started trading, but these are disciplines you need to understand. After a month of trading, you'll realize a lot more of why these things are crucial to be a successful, disciplined trader. If you watch this video, you should have a much better understanding now of some of the information and tools and concepts that we use on a day-by-day basis to perform technical analysis and spot some setups in the Forex market. Of course, all of this stuff is just the beginning and just the basics. There's so much more to learn and so much more time to be spent on these exact topics. If you're looking to make trading one of your sources of income this year, or even take your personal trading to the next level, make sure you join my Inner Circle community where there's more than 400 traders active following the information that I teach and having real success stories. If you're a new trader and you're serious about becoming a trader and you want access to the inside information that we have inside my Inner Circle and are looking for these types of results, like some of my top students, including Giorgio, Nicole, Matt, and Carrie Ann here, who have made thousands of dollars inside my Inner Circle, check out the link in my Instagram bio, and I'll see you guys inside the Inner Circle.